Good to see everyone. Welcome to the American Enterprise Institute. I'm Kyle Pomerlow. I'm a senior fellow here at AEI. AEI is delighted to host this conference, Complexities, Discontinuities, and Unintended Consequences of U.S. International Tax Rules, Options for Change. In 2017, lawmakers passed a much-needed overhaul of to the taxation of multinational corporations. Although reform followed years of debate, these provisions were proposed and enacted in a very short period of time. As a result, we are still analyzing their effects. Today and tomorrow, we will be discussing whether those provisions are working as intended and accomplishing their goals, and if not, how lawmakers should approach reform. And before we begin, I want to thank a few people. First, I want to thank Mindy for bringing this conference to AEI. Second, I want to thank my RA, Atman. He successfully navigated AEI's bureaucracy, and the reason this is being held is because of him. And then finally, I want to thank our sponsors for this event, Skadden, McDermott, Will & Emery, Steptoe, Covington & Burling, Miller & Chevalier, PricewaterhouseCoopers, EY, KPMG, Deloitte, tax analysts, and the University of Florida. And one administrative point before I pass it off to Mindy. During question and answer sessions, there will be mics in the room. Just raise hands, wait for the mic, and make sure you introduce yourself before asking your question. And with that, I'll pass it off to Mindy.
Thank you, Kyle. And so nice to see everyone. It's like a big party for me because I know so many people here. Thanks, everyone, for coming today. So I want to spend some time, but before we get really started, talking about what we were trying to do here, why we started this project to begin with. Sorry. And what we're trying to accomplish. So we started about 1.5 years ago when Paul Osterhuis said to me, Mindy, you should really, there's going to be tax legislation in 2025, and a lot of the TCJA provisions are going to come for another look, and some of them are going to be, the rates are going to change. We should look at these provisions closely and also look at pre-TCJA. Mindy, you should put a group together. You should get a group of smart people. You should get Pep Brown and put a group of people together to really take a hard look at both the TCJA law and the pre-TCJA law to see how they're working. It's a good time also, even if I think one of the things I realized while we were doing this is that even if there wasn't big legislation expected in 2025, 6 going on 7 years is actually a really nice time to take a look at what the TCJA law changes did and try to make sense of what they're doing, whether they're working as intended or where they could stand some to be modified a little bit. So that's what we did. We Paul and Pat and I, with a steering committee, put together a list of topics to consider and a group of people, mostly all ex-government people, mostly ex-Treasury officials, Joint Tax Committee, IRS, but all now in private practice, so people really experienced with working with the technicals of the law, to how they apply to how taxpayers have to deal with them every day. And what we're deal with some big picture issues, but really we want to take a very technical approach as to what's working, what's not, looking at the words on the page, the law as it applies. So we had some guideposts that have driven both the topics and the way we approached all the topics. Number one, we were trying, and I am glad to say I think we succeeded in very nonpartisan approach. So staying away from topics or taking positions that have strong political polarity. But also then also taking into account concerns, so a lot of technical viability. Does this rule, is it working as it's intended? How is it functioning? Also from a compliance perspective, from the taxpayer's perspective, and also its administrability from the government's perspective. And then so not just looking at each provision in isolation, but how they interact, because obviously TCJA was such a significant reform that it was essentially not possible to fully think through beforehand, although George will tell me that he thought everything through. How the different provisions work with each other. Then also thinking about not our overarching concerns, but also keeping in mind concerns about U.S. competitiveness, domestic policy more generally, and also a big issue, obviously, the shifting global tax landscape, obviously global minimum tax that was enacted, the possibility that Pillar 1 might still happen, and other countries enacting digital services taxes. Also taking into account, but again, not our overarching concern, U.S. revenue needs and political realities. What we were not trying to do, and I know there are other groups working on this, is we weren't attempting to rethink U.S. Tax policy, U.S. international tax policy broadly. We weren't trying to come up with policy choices that lawmakers, that we think lawmakers should be taking. Instead, we were very much operating from the law as is and thinking about whether it's working to meet policymakers, legislators' objectives. And also, we're a group of lawyers primarily, and so this is a legal analysis and not an economics analysis. We're really focused on the way the law works and what the rules as written are doing, whether good or bad. Our overarching goals were number one, to provide useful guidance to policymakers, to lawmakers, to staffers as they think through the next round of revisions to U.S. law. And I'm really glad to say that along the way, we got just outstanding work products, summaries of existing law that took into account the history of different provisions and the evolution of the law, and also really from a group of incredibly thoughtful and insightful people, how to think about the interaction among different provisions. So really, it's been one of the highlights of my career to work with such a group of really smart and talented people as they think through these topics. So to run through the topics briefly, and on your tables, you'll have the draft papers that tax analysts put together. For us, we were focused on timely topics and also topics that are getting a lot of attention now. So obviously, number one is GILTI Subpart F and ancillary topics there, ownership, how to determine CFC status, and how to allocate Subpart F GILTI income to shareholders. Foreign tax credits, obviously, a very big topic. And then getting to somewhat smaller topics, but still large topics, foreign derived intangible income deduction, FDII, and how that interacts with other incentives. The sourcing rules, so sourcing rules are just fundamental to the operation of U.S. international tax rules, don't get enough attention in really technical discussions. And we're mostly focused on outbound, but we do have a paper for discussion of some limited inbound topics. And then a couple of papers on cross-border transactions. So one thinking about Section 1248, sale of CFC stock, and the participation exemption enacted in 2017. And then also cross-border tax-free transactions, or Section 367 dealing with otherwise tax-free transactions. And then a really interesting paper, I think, on branches. And so we have very divergent treatment in the U.S. between whether a foreign business income is earned in a corporation in a CFC or in a branch, and so we have a really great paper that teases out the reason why what those differences are, why they're there, whether they make sense. Then another really small topic, transfer pricing, but looking at whether really, I think the driving question there is what should Congress be, or what areas might it be worth it for Congress to provide more guidance to Treasury. And then we're mostly focused on business income, on corporate, but got one paper on individuals who are engaging in cross-border tax transactions and the different tax treatment for individuals versus corporations, especially made more obvious as a result of TCJA. So our guideposts in writing these papers and drafting these papers and thinking through what topics and what recommendations to make really is, number one, we are focused on the legislation. So we're not, we mostly stay away from administrative rules from IRS and Treasury guidance to focus on the code. And like I just mentioned, also considering strongly where Congress could or should be giving more guidance to administrative agency. And then also in terms of what's going on globally, accepting the reality that the global tax landscape is changing with the global minimum tax and other countries' greater assertion of taxing rates at source and attempts to tax digital, but not so accept that the world is changing, but not necessarily committing to the U.S. Needing to conform to those changes. So I'll pile on to Kyle's thank yous. And so number one, thank you to Paul for really having this idea to begin with and for dedicating an enormous amount of time and energy to the project since day one. And then also Pat for also being enthusiastic as soon as I followed Paul's direction and called him and asked him to work on this. Then I have to thank University of Florida Levin College of Law and especially Acting Dean Merritt McAllister for their support for this event and for this project and for supporting my working on it. AEI for hosting it. And also, as Kyle mentioned, the team has been fantastic, the AEI events team and Kyle's assistant for working with us. And then Tax Analyst, which has published, as you all have, the drafts of these papers, and the final versions will be rolled out in tax notes over the next several weeks. Then the steering committee, who really guided this project, that includes Paul and Pat, but also Kim Blanchard, Pam Olson, Eric Solomon, and Lowell Yoder. And then the working group who really dedicated enormous amounts of time for over a year now, and that includes David Noren, Kara Mungavin, both up here, Michael Caballero, Ron Dabrowski, Harrison Cohen, Jose Murillo, Josh Ruland, Eric Sensenbrenner, Caitlin Hurd, Amanda Pedvin Varma, and Nita Asher. And then also a special thank you for their support, Noha Nayeri and Iman Kyler, who are going to be moderating all the sessions and keeping time. So they're the reason why we're all going to get lunch tomorrow. And there will be lunch tomorrow. Apparently some people asked, but there will be lunch here served tomorrow. And just a couple of caveats before I turn it over to this group. One is that the views expressed here are collectively the group's views. They're not any one individual's recommendation or perspective. So the group stands behind, as a whole, these recommendations. And the second is that the drafts that you have that are posted on the AEI website and that are in this hard copy that Tax Analyst has put together, that they're working drafts, and the final versions will be published after the conference by Tax Notes. So with that, I'll turn it to you guys.
Thanks for that, Mindy. Hi, everyone. My name is Iman Kyler, and I will be introducing our first set of speakers. To start with the presenters today, we have Cara McGowan, who's a partner at Davis Polk, David Noren, who's a partner at McDermott, and for our commentators, we have Joan Bates, principal at Deloitte, George Callis, who is Executive VP of Public Finance at Arnold Ventures. And then finally, we have Chip Harder, who is a Senior Policy Advisor, retired at PwC. In addition to the folks on the stage, we will also be hearing from Paul Osterheis, who is off counsel at Skadden and also lecturer of law at Columbia Law. And we will also have Kim Blanchard as well, who was a partner for over 30 years in private practice and is currently with the law office of Kimberly Blanchard PC. Thank you so much for all of the speakers and really looking forward to this discussion. Cara, I'm gonna hand the mic to you.
All right, so the first topic we're going to cover relates to various design differences between the Subpart F regime and the GILTI regime. Notwithstanding the fact that both of these regimes tax a U.S. shareholder on a current basis on various categories of income generated by their CFCs, there are numerous and actually quite substantial differences between the way these two systems are designed. Now, there could be good reasons for these differences. The two regimes obviously tax different categories of income, and therefore they serve different purposes. So we're not starting from the premise that there should be no differences, really just that any differences should be carefully thought through, and there should be a real basis to support any differences. Now, before we dive into the compare and contrast between the two regimes, I think it's instructive to review a little history. So prior to the 1960s, the US had a worldwide tax regime, and indeed long after the 1960s as well. So US shareholders of CFCs were taxed on their worldwide income, so income generated abroad, at home and abroad, including through CFCs. But with respect to the CFC income, of course, the inclusion was deferred until the income was repatriated, so until the CFC distributed a dividend or until the US shareholders sold the CFC. Then Congress began to worry about the possibility of deferral. So in particular, they were worried about US taxpayers generating passive income, which is of course easily or highly mobile. They were worried about them generating this type of highly mobile income offshore in low tax jurisdictions through their CFCs, and basically not paying any or very little foreign tax on that income. And then since they had control over when they could repatriate the dividends or sell the CFC, they could defer indefinitely the US tax, the US income inclusion and the tax on the inclusion as long as they liked. And so in response to this, in 1962, Congress enacted Subpart F. And with that new legislation, they defined a new category of income, Subpart F income, which was for the most part passive income, and effectively accelerated the income inclusion attributable to Subpart F income. And so under this new or then new regime, a deemed dividend was created. So, if the CFC generated Subpart F income, then there was a deemed dividend from the CFC up to the US shareholder that would effectively accelerate the dividend that would ultimately have been repatriated anyways. And so it was really just a timing difference, potentially a huge timing difference, right, going from indefinite deferral to current inclusion, but it was a timing difference. And so a lot of the design features of the Subpart F regime can be explained by the fact that Subpart F income really represents an acceleration of an income inclusion in the form of a deemed dividend that would otherwise have occurred in the form of a dividend. So for example, Subpart F inclusions they're calculated separately for each CFC because dividends are calculated separately for each CFC. And they're limited to E&P, or Subpart F inclusions are limited to E&P, and that makes sense because dividends are limited to E&P. And that was the regime that was in place for 55-ish years. But then if we fast forward to 2017, by that time, the United States and our worldwide tax regime, we were kind of outliers among our peer nations who had mostly shifted to territorial regimes by that time. Also, our corporate income tax rate at 35% was much higher than most of our peer nations. And so in response, as I think everybody is well aware, in December of 2017, Congress enacted the Tax Cuts and Jobs Act, or the TCJA. And with it, they made sweeping changes to the international tax regime, including they enacted a limited participation exemption regime under which corporate US shareholders could generally repatriate dividends from CFCs tax-free. Now, it always struck me as somewhat odd that Congress would, on the one hand, enact a participation exemption regime that effectively permitted corporate US shareholders of CFCs to repatriate earnings tax-free in the form of dividends, but they didn't change the Subpart F regime. Right? So Subpart F accelerates a dividend and taxes the recipient on that accelerated dividend, even though an actual dividend would not be taxable anymore. So I'm not suggesting that Subpart F income, that it wouldn't be appropriate to tax Subpart F income or passive income currently, but it's the design of the system that I question, just with the Subpart F system being an acceleration of a dividend when we no longer tax dividends from CFCs to corporate US shareholders. Now, of course, the TCJA also included the GILTI regime. And according to the legislative history, in enacting the GILTI regime, Congress was apparently concerned about multinational corporations generating highly mobile income from, this time from intangible assets, in low or no tax jurisdictions, and therefore not paying tax in the local jurisdiction, and then being able to defer the US tax on that income inclusion, assuming, of course, that the intangible income was not Subpart F income, which it typically wouldn't be, as long as it was generated as part of an active trade or business, and as long as they didn't repatriate the earnings, in fact, through dividends. So in response, Congress enacted GILTI. Under GILTI, they, of course, tax US shareholders currently at a reduced rate on essentially all of their income, other than Subpart F income and subject to a couple of other exceptions, and with a reduction for a deemed 10% return on tangible asset basis. So now we have two regimes. We've got Subpart F and we've got GILTI. Both impose tax currently on a US shareholder in respect of income generated through CFCs. Both on categories of income that Congress views as somehow suspect, largely because it's mobile, right? Passive income and income on intangibles. And therefore, I think the concern is that the income can be generated kind of wherever, and so you can place it in no or low tax jurisdictions. And so notwithstanding the similarities in what the systems are getting at and the motivation for enacting the systems, there are pretty stark differences in how the systems are designed. And so the natural question in my mind is, why are those stark differences there? And one that jumps out at me in particular is the fact that Subpart F inclusions are limited to E&P, and GILTI isn't, right? E&P is completely irrelevant when you're calculating your GILTI inclusion, and yet it's of crucial importance to the Subpart F inclusion. Now, I will say it makes sense to me that GILTI is not limited to E&P because dividends aren't taxed anymore, but I struggle to see why Subpart F inclusions continue to be limited to E&P. Now, there were, of course, good reasons at one time for the limitation to E&P, as I alluded to before, that when dividends from CFCs were taxed to their corporate parents and Subpart F income represented an acceleration of that tax, it made sense to define or to compute the income inclusion or the accelerated income inclusion in the same way you would compute the ultimate income inclusion, right? So it made sense for the deemed dividend to be limited by E&P because an actual dividend would be limited to E&P. But since we no longer tax dividends, I don't really see as a theoretical matter why we continue to impose the E&P limitation on Subpart F. Now, I would, of course, pause on the practical effect of the E&P limitation. I wouldn't want to throw it out or suggest throwing it out if it's really important as a practical matter. But I think actually a lot of what it did as a practical matter, does as a practical matter, is permits loss sharing between categories of Subpart F income and losses in non-Subpart F categories of income. So for example, if you have $100 Subpart F inclusion, or $100 of income items that fit the Subpart F definition, then you would typically also have $100 of E&P from that economic income. If you also have an operating loss of $100, then you would typically have an E&P loss of $100, and the E&P would sort of net to zero. So you'd have $100 of income of Subpart F income, $100 operating loss, and no E&P. So even though you had $100 of gross income items that fit the definition of Subpart F, you wouldn't have a Subpart F inclusion in my example because your E&P would be zero. And so in that way, the operating loss can sort of offset the Subpart F inclusion. However, when Congress enacted GILTI, they actually also enacted a provision that basically is a no loss duplication rule that says that E&P of a CFC is increased by tested losses. So tested losses are GILTI losses. So that effectively says that if you have an economic loss that's creating a tested loss and therefore reducing your GILTI inclusion, that cannot depress your E&P and also offset or absorb your Subpart F income. So if you effectively can't share losses in the current year between Subpart F income and tested losses, that loss sharing has kind of been eliminated, there's not a whole lot left for the loss sharing in the current year. You can, of course, have losses in categories of income that are not Subpart F and not tested losses. Those are still available to offset Subpart F income, but that's a much narrower category once you take out the tested losses, which are effectively your operating losses. Likewise, qualified deficits that carry from one year to the other have historically been a way to sort of carry forward losses for Subpart F purposes, but these too have been curtailed with the GILTI regime because there's another rule that was enacted in 2017 that basically says, as a practical matter, that economic losses that give rise to tested losses cannot create or increase qualified deficits. So I'm just left here wondering, what's the theoretical justification these days for the E&P limitation, and also what's the practical import? I'm not suggesting that if there is any loss sharing that we should eliminate it just for the sake of it, but I do just sort of wonder kind of either the theoretical justification or the practical import. And I would also just observe that GILTI is computed on a blended basis that permits loss sharing between CFCs. Now, in the current year, not year to year, and we'll come back to that point. And so I wonder whether Congress should just consider having a single basis on which to compute Subpart F and GILTI inclusion. So for example, a CFC could categorize its gross income and loss items into three categories. Number one, tested income or loss. Number two, Subpart F type income and loss. And then number three, all other income and loss. And then the items in the first category, that tested income or loss, they could be aggregated together to compute the GILTI inclusion. The second category, the Subpart F, that could be aggregated for the Subpart F inclusion. And then the third is the sort of miscellaneous category if Congress wanted to continue to permit loss sharing between Subpart F income and non-Subpart F, non-tested losses. That third category of losses could essentially be shifted into the second category. This system would permit different rules for carrybacks between the three different categories and carry forwards. It would permit different tax rates to apply. We may continue to believe that a higher tax rate is appropriate on passive income versus active income. But in this way, the two systems would be sort of meshed together in a way that I find to be a little bit more coherent. So with that, let me turn it over to the panel. Yes.
I'm intrigued and sympathetic to your proposals to try to put everything on a more uniform basis, but I do want to point out that this is technically very, very complicated in that you got to do more than that because, for example, I think the drafting of the definition of foreign personal holding company income basically assumes the operation of the E&P limitation because, not to get too weedy here, but foreign personal holding company income is the sum of the positive amounts in different categories of foreign personal holding company income, not netted against the losses in those categories. So you can have a situation where, let's say, a CFC has $100 of foreign currency gains and simultaneously $100 of losses on disposition of securities, maybe the same securities that gave rise to the currency gains, and those don't net out against each other. There's still $100 of foreign personal holding company income. So the E&P limitation where you don't have anything else in the CFC, steps in to make sure that the Subpart F inclusion is not more than 0 in those facts. And so, I'm quite sympathetic to your idea, but I think you might want to also go through and figure out whether the definitional provisions defining foreign personal holding company income, which I assume one would want to retain in a new system, whether those definitional provisions were written in a different world and whether they'd still be fit for use. But yeah, it's a very weedy enterprise trying to do something as fundamental as that, given that the code is a seamless web. So all the more reason to start thinking about this now, rather than just having it done in reconciliation in 4 weeks or less.
I don't dispute or disagree with any of
right,
that.
yeah.
And I wouldn't suggest that revamping the system in the way I suggested would be simple.
Yeah, right.
But I also wouldn't suggest that our current system benefits from the virtue of simplicity. I think it benefits from inertia, right? We all know how to calculate Subpart F income, and that is something.
Yeah.
And if we switched it all up and
Right.
did something else that was very complicated, even if it was slightly less complicated, it would be harder for a while, right?
And we all know to put our treasury centers in a CFC that has no non-Subpart F income, no non-foreign personal holding company income, to avoid these whipsaws, which might then no longer be avoidable.
And they are relics of the prior system, right?
Absolutely.
They're only there because of the E&P limitation, which I just struggle to see the continued sort of validity of, other than the historical significance and the inertia point and how difficult it is to make big changes. But if we are thinking, what would we do with a blank slate? I don't think we'd come up with anything close to our current system.
Yeah, I wouldn't defend the current year E&P limitations. The one, I don't think it really did a good job of limiting Subpart F inclusions based on what would be a dividend, because it doesn't take into account accumulated E&P. But I think, Chip, more to your point, I think the real problem is with siloing groupings of income under 954 and 960 so narrowly. I think it actually is harmful to taxpayers, ends up overstating Subpart F income over time because you're effectively losing losses because you're applying U.S. expense apportionment principles and then losing foreign tax credits because you're applying imperfect rules for allocating taxes between groupings of income. So I actually think it's probably an adverse system to taxpayers on the whole, and you'd be better off bucketing Subpart F income groupings more broadly, like maybe apply 904 categories and then group everything together, and maybe even apply it at the U.S. shareholder level like you do with respect to GILTI.
So I guess I'll jump in and first caveat that I've been in a role for several years where I have not been working with these rules in any detail. But you did give me PTSD for my days on the road working on developing these things. A couple of high-level comments, maybe. One is that I would, the GILTI approach. There was an earlier version, and it's in the public domain because it was the bill that former Chairman Dave Camp introduced back in 2014 as HR 1, where you can go and find this. There was an earlier version where it wasn't called GILTI, it was called Foreign-Based Company Intangible Income. And it was a new category of Subpart F income. And what I'm about to say, I think, is a laugh line, which is we moved toward the overall approach because people thought it would be simpler. And I'd be, this is for another day, I think, but I'd be very interested in hearing from taxpayers and practitioners who've now been working with these rules for a number of years, whether it's simpler or more complex compared to a situation where you'd just be completely within the Subpart F regime with a different category of base company income. You could still have a Section 250 deduction that applied to that. You'd still have the QBAI 10% exemption. You could still have all of that within that new category. But I'd be, same high tax exception, same foreign tax credit rules, et cetera, et cetera. I'd be kind of interested in that. But the other thing I would say is, at least early on, when the overall approach that became 951 Cap A was being conceived of in Congress, I think the people developing it probably would have been very surprised to look into the future and see situations where people might want to plan into Subpart F to get out of it, right? It was, I think it was supposed to be, originally at least, unambiguously equal to or more pro-taxpayer than Subpart F. There was not really supposed to be any situation where you'd rather be subject to Subpart F than this new rule.
The glories of our foreign tax credit.
Right, that's really interesting because I focus my practice on M&A, and when I'm talking to a client about selling a foreign business, the sort of first consideration is, would we rather sell stock and recognize capital gain that will fall into the Subpart F category, or would we rather sell assets and have a GILTI inclusion, or some combination, right? And with the foreign tax credit rules applying differently to the different categories or the different regimes, and the foreign tax credit limitation rules being different, you can't really ballpark that. You kind of need to get the accountants to crunch the numbers and come up with the answer. But there is an answer, and to me that introduces a lot of activity that I'm not usually in favor of.
More to come on that when we get to Subpart F sales and services.
Yes. So let me open up to the audience and see if there are questions before we move on to the next.
I mean, one more quick point. I mean,
yes.
the current limitation, it's just a timing rule, right? You do have recapture in a future year. So I don't know what purpose it really still serves.
Kim, there's a mic. Sorry to interrupt.
Yeah, it's really interesting that I think you're right. You must be right that people at the time didn't think that anyone would plan into Subpart F, presumably because they thought the rate was higher, like twice as high. But that does suggest that they were not aware of the full extent of how our foreign tax credit rules work. Is that a proper inference?
Well, I think that's why I tried to say, at least in the early days, or when we were at a more conceptual level, I think what happens is you get down, when you're on Capitol Hill, you get down a road, and especially when it takes like months to get a single JCT estimate back on a different option, right? Like it's not just because it was done in a few weeks, it was done over a period of years, and yet despite that much time, it's actually very little time, and once you get down a road, it's hard to pivot. My recollection is, there was a 2013 Harry Gruber, Roseanne Altschuler paper that raised the overall approach and compared it to a per country approach, which is kind of part of the debate today, right, with Pillar 2 and with the Biden proposals. I continue to kind of smirk at that because the original approach was a per CFC approach, and no one in Subpart F, and no one talks about that anymore. Which is kind of a blend of the two, because you still have check the box blending, but not global blending. I think what happened. So that paper came out. People started talking about it. I think much of the business community believed this would be preferable to doing it in Subpart F, allowing us to blend income and taxes globally would be preferable. And so you go down a road, and once you get far down that road, you got to continue answering questions like, we're going to need new foreign tax credit rules, et cetera, et cetera. How do we handle that? And it's just sort of at a certain point, it's sort of hard to pull back. You've done what you've done, and then you get into a situation where, frankly, you have budget constraints. You have a reconciliation instruction, you have budget constraints, and members of Congress, and it's going to shock people in this room, members of Congress do not prioritize international tax the way they do individuals, pass-through entities, the estate tax, things like that, right? And so those things become non-negotiable, and it reduces the room on. Look, I always said, I'll hold my comment on this to QBAI, but I have an example of that on QBAI as well.
So this process isn't simple? Is that what you're saying?
It's not simple, but it's hard to turn a battleship, and there's always trade-offs you have to make, right?
Sure. Yeah, fair enough. Okay, so let's move on. The next topic is about the fact that GILTI is calculated on an annual basis. And so tested Losses don't carry forward or carry back, and if there are excess foreign tax credits in the GILTI basket, they just expire. They don't carry forward or back either. And so, thinking back, and this sort of goes back to the comments that were just made, when GILTI was first described by Congress, it sounded quite limited. And indeed, the name sounds quite limited, right? Global intangible low taxed income. And if you read the legislative history, you, or at least I, was left with the distinct impression that as long as you don't move your intangibles into low tax jurisdictions, so basically as long as your CFCs pay at least 13.125% tax in each of their home jurisdictions, that you as a US shareholder won't have incremental tax to pay. That is, in fact, what the legislative history said. But I think a careful read of the statute, and certainly lived experience of the past 6.5 years, would suggest that GILTI is in fact much broader and a much more sweeping regime than either the name or the legislative history would suggest. And indeed, even if each of your CFCs is paying tax at or above 13.125%, you could still very well have US GILTI tax to pay. And this, of course, comes down to two main reasons. The first is it's nominally limited to intangible income, but the way this is accomplished is you basically pick up all income other than Subpart F income and then a couple of other discrete limitations, and then subtract out a 10% deemed return on your CFC's basis in their intangible assets, or QBAI, which is, of course, a proxy for tangible income. So effectively, if you start out with all of your income and then you subtract out a proxy for tangible income, the theory goes you're left with intangible income. But whether you think tested income, what you're left with, is a good proxy for intangible income, really comes down to whether you think QBAI is a good proxy for tangible income. And while I don't necessarily think it's a great proxy, that will actually be part of our next big topic, and so I'm going to put a pin in that just for now. The second reason GILTI is a lot more sweeping than at first it was described is because it's nominally supposed to apply only to low tax intangible income, but the way this is accomplished, of course, is through the foreign tax credit system. Setting aside the high tax kickout, you get an 80% foreign tax credit for the foreign taxes on tested income. And so as the theory goes, as long as you pay 13.125% foreign tax, you get 80% of that will get credited, which is 10.5%, which is, of course, the effective rate on GILTI for US corporations, and you shouldn't have to pay any GILTI. That's what Congress said in the legislative history, and that is completely true, as long as you completely ignore the foreign tax credit limitation regime.
Yeah, right.
But Congress didn't exempt GILTI from the foreign tax credit limitation regime. And so once you take that into account, you don't necessarily get to use all your foreign tax credits. And so you could easily be in a situation where your CFCs are paying 13.125% or substantially more tax in their home jurisdictions, and you still have to pay GILTI. And so with that in mind, with the fact that GILTI is not so narrow and not so specifically targeted at intangible income generated in low or no tax jurisdictions, then I'm not sure that I understand the justification or see the justification for the sort of rough justice approach that maybe would have been appropriate for a more limited kind of anti-abuse regime had GILTI actually been designed in a way that was a more limited anti-abuse regime. So, I mean, I just think that calculating on an annual basis is completely inconsistent with our domestic tax regime and how we calculate income there. I mean, we allow loss carry forward specifically to alleviate the distortion that our annual accounting period would otherwise create. And if you think of GILTI as sort of an extension of that domestic tax regime, then it's difficult to see why we would take such a different approach. Now, I realize that this is to your point, Jim, about simplicity and complexity. Allowing loss carry forwards would be enormously complex, right? And probably would have to be done at the shareholder level as opposed to the CFC level. So I think I understand the reason behind some rough justice, but I do have a hard time accepting the annual accounting period for GILTI when it's such a sweeping regime. But let me open it up for comment.
I agree with you, but I think it's the lesser issue than the fact that almost all U.S. multinationals are or will end up being in an excess credit position in their GILTI basket. So they will not actually end up paying a so-called top-up on their GILTI income, no matter how measured. And instead, what they're losing is the tax benefit of domestic expenses allocable to their excess credit, GILTI basket, which is an enormous effect. And yeah, you're now triggering my PTSD because as we were trying to write the GILTI regulations, we were being bombarded by calls from the Hill saying that, but if you pay 13 1/8% on your GILTI income, there should be no marginal tax resulting from owning these CFCs. And try as hard as we could not figure out how to completely exempt GILTI basket from the allocation of domestic expenses. And we saw our way clear to reduce it by regulation, the amount of the allocation. But at the end of the day, I think the most significant thing about the GILTI architecture now, particularly when we're going into a Pillar 2 world, where if it's at all effective, essentially all US multinationals will end up with a blended rate in their GILTI basket of at least 13 1/8%. We're not collecting any revenue on the GILTI inclusion itself, and which standing alone would put us US multinationals in a pretty comparable position with their foreign multinational competitors. But what we are continuing to do is deny the benefit of greatly increased amounts of allocable domestic expense, like interest expense and headquarters expense, because more of the assets are now in the GILTI basket that is now an excess credit basket. And so, the effect of allocating expense against that excess credit basket is essentially to offset the income tax benefit of those expenses allocated to it. And so I really think going forward into rethinking GILTI in a post-Pillar 2 world, where both the revenue considerations and the burdens and competitiveness considerations are really focused in the fact that we use a foreign tax credit mechanism to offset double taxation on GILTI income, rather than something like a simple foreign tax credit limitation, as you discuss in your paper, or a Pillar 2 top-up mechanism.
Right. And if we move toward Pillar 2 conformity, which I think it's anyone's guess whether we do, does it make sense to continue to use the foreign tax credit system that we have, or should we move to something more like a top-up tax?
There's always the option of just adopting Pillar 2 as in our international regime, but that's more expansive than this seminar is considering. Yeah.
Oh, there's a question from the audience.
I don't want to take a position on whether or not the high tax exception should apply the way it did, but I think that it would be interesting to get your comments about the root cause problem. When GILTI was enacted, the high tax exception under Subpart F was done on a CFC by CFC basis, and you could decide not to have income included under the high tax exception. When the regs came out, Treasury went a totally different direction, both on GILTI and Subpart F. So now we have a high tax exception applied overall on a total basis. And I just wonder, I don't think we should, when I look at the rules, I don't think it's George Callis and what Congress thought. I think they could rationally have believed that If you paid a 13.25% rate, you could elect to be out of GILTI because of the high tax exception, and the regs went a different direction. So I wonder if the reform, if you wanted a reform, and I'm not advocating for a reform, is really the result of regulations that came 18 months later, not the initial thinking of the GILTI rules.
So it's an interesting question. I mean,
I'm not quite sure, what you're driving at, but we did, enact the high tax exception where it's measured on a CFC basis, but you've got to elect to have it apply to either all or none of your CFCs. And we did that for basically fear of cherry picking and as a design judgment, I'd say. And it was in the context, some of the thinking was in the context of the foreign tax credit and expense allocation, thinking that if the overall design was really to, create deferral, or I'm sorry, complete permanent territoriality with respect to certain CFCs that that it makes sense to allow a taxpayer with a CFC with a 20% or 19 whatever effective rate to essentially treat all of its income as deferrable income, and then the stock would not attract a allocation of domestic expense. But
Yeah, my only point is simply that with the benefit of hindsight, there's a lot more anomalies with the way the high tax exception and the regs have been put in than perhaps the Treasury did when they enacted that bill. And so if we're rethinking that question, I think a root cause analysis would say maybe we should rethink the high tax exception and how it was interpreted. Because if someone really is not in the place that they should have an exemption, for the reasons
Yeah.
that legislative history said, we're creating it because of the way the high tax exception through the regulations. That's my only point. But I know there are a lot of arguments. But my view, I think that's the root cause.
yeah, well, and a number of commentators have said we had a rather thin reed to rest on to create it for GILTI in the first place. But again, we did it in the larger context of the foreign tax credit limitation and the allocation of domestic expenses and the stated legislative purpose of having the ability for substantial amounts of territoriality in the system rather than de minimis amounts of territoriality in the system.
I think there's a current chairman of the Senate Finance Committee who insists that Treasury didn't have any authority to create any kind of high tax exception for GILTI.
one observation about the high tax exception for GILTI is that if the taxpayers that are electing into it are primarily taxpayers that are negatively impacted by the interest allocation and apportionment rules in the foreign tax credit limitation regime, or potentially taxpayers that have domestic losses that they don't want to use to offset GILTI, that if you believe that those two features of the GILTI regime are appropriate, then allowing taxpayers to simply elect out might not be the best policy. And if you believe that those two features aren't appropriate, then maybe fix the system, right? Rather than let some taxpayers use it to their advantage and others not.
I mean, a third category is taxpayers that have BEAT liability and can't use the foreign tax credit.
Thank you. Thank you.
Yeah.
Okay, so in the interest of moving on, I did just want to touch on one more topic about Subpart F and GILTI before we move on to more specific discussions of QBAI, and that is the fact that domestic NOLs are used to offset or must be used to offset GILTI inclusions. So the effective rate on GILTI for U.S. corporate shareholders is currently, of course, 10.5%. Mechanically, though, the way this is accomplished is the full 21% tax rate is imposed on GILTI inclusions, but then there's a deduction under Section 250 to the tune of 50%. of GILTI. But that deduction is scaled back if there are domestic losses. And what that means is that if there are domestic losses that would otherwise have been available to offset domestic income that's taxed at 21%, they have to be used to absorb GILTI and FDII, which is not the focus here, that would have been taxed at 10.5% in the case of GILTI and 13.125% for FDII. And so while I do appreciate that there should be some loss sharing potentially afforded between the two systems so that you don't end up with a corporation who's carrying forward a domestic loss, which of course could be very valuable or not valuable at all, just depending on the prospects for the domestic business. And so they're carrying forward that loss and then simultaneously paying tax on their GILTI and FDII inclusions. But it does seem a little tricky that a domestic loss should be rendered less valuable simply because the corporation has GILTI and FDII inclusions, which are themselves taxed at preferential rates. Said a little differently, why should GILTI cost 10.5% if you're paying kind of tax on the GILTI, but then if you're paying in kind of NOLs, they cost 21%. Now, I'm usually pretty hesitant to recommend taxpayer elections, but I do wonder whether this is an appropriate case for an election to use a domestic loss or not, because the question is really whether the taxpayer uses a real economic loss to offset GILTI inclusions in kind of an expensive way versus preserving that economic loss for use at a later date against domestic income. And I would note that there is some precedent for that approach here, right? Of course, in 2017, as another part of the TCJA was the transition tax under 965 that helped us transition from a world without a participation exemption to a world with a participation exemption. So CFC's unrepatriated earnings were taxed at a preferential rate, and I think it was 965N permitted a deduction to either, for taxpayers with domestic losses, to either preserve the losses and pay tax on their inclusion, on their repatriation inclusion, or to offset the two. So I wonder whether here might be an appropriate case for that sort of election, albeit on a more permanent basis, and 965 was kind of a one-time thing. Other comments?
I'll try to maybe play a little bit of devil's advocate on this one,
Okay.
because I'm conflicted. I don't know exactly where I come down. I think you can make arguments both ways. But this issue, by the way, I think became particularly politically salient in the spring of 2020, right, when the CARES Act was enacted and all these NOL, liberalized NOL rules. I mean, it existed before that, but people really started paying attention to it, especially people who aren't dealing with this every day, people on Capitol Hill and so forth, when things were falling apart. Trying to avoid more colorful language. So I guess the issue is, the rate cut itself from 35 to 21, right, reduces the value of your NOLs. It reduces your deferred tax asset on your balance sheet. A rate cut does that. And if you think of GILTI as a rate cut on a particular category of income, implemented through a deduction, but it's really a rate cut, and Congress chose not to draft it the way the special schedule for capital gains is, where it's actual, you have to break out the income and then apply separate rates to it, just used a deduction, but the policy intent was really a lower rate on that income. Then the question becomes, well, if you're going to provide taxpayers with the benefit of a lower rate on some of their income, should you then sort of double down on the benefit by also letting them not apply their NOLs to that income and only use NOLs against higher taxed income? And I can see an argument for saying, no, this is a benefit. Congress could have taxed it GILTI at 21%, and then we wouldn't be having this discussion. But Congress is taxing it at a lower rate, just like, the NOL would be great again if you could take it at a 35% rate, but we have a 21% rate. So again, that's kind of a, I guess, partial devil's advocate posture, because I do see the argument the other way. But I did want to put that out there that when you think of it as giving the benefit of a lower rate on a certain category of income, is it really that onerous to then say, well, yeah, and your losses still apply to that income?
Yeah, it's just that your losses are worth different amounts depending on your mix of income.
Right. But that's
No,
why I
it's a
used
great
the
point.
example of the rate cut, right?
Yeah.
I mean, the rate cut was, the rate cut makes your losses worth less.
Yeah, that's a good point.
And like current year losses against capital gains.
Right, that's right.
So let me just ask if there are questions from the audience. I want to spend 5 minutes on QBAI before we move on to some interesting topics David has to cover. Is there anything from the audience? Okay, so we go over some technical points about QBAI in the paper, but I'm going to skip over those in favor of the sort of big picture question, which is, do we need it? So QBAI, I think I mentioned earlier, is sort of, in my view, a poor proxy for tangible income, right? It's based on tangible asset basis and not value. And tangible asset basis doesn't really bear much of a correlation at all with economic return. I understand the need for simplicity, of course. But if it's not a great proxy, and it also does tend to favor some industries over others, companies that operate in the manufacturing space tend to have a lot of tangible assets and therefore a lot of tangible asset basis. Now maybe they have a lot of tangible income as well. But where do we go from here with QBAI? I mean, if we pursue Pillar 2 conformity, and the Pillar 2 rules, of course, have a similar concept, the SBIE, it's a little bit broader, it picks up employee costs. So we might want to think about conforming our QBAI with the sort of QBAI equivalent under the GLOBE rules if we do pursue conformity with those rules. If we don't, then we really don't have external constraints. So I think there's a real question. Do we try to refine it, make it a better proxy for tangible income so that GILTI is a better proxy for intangible income? Or do we throw it out altogether in favor of maybe other tax spending that is more targeted or specific or has more clearly defined benefits? Let me pose that as a question to the group. I think it's a really interesting question and one that doesn't necessarily have, in my view, a clear answer.
Yeah, I think this is basically a political policy decision, whether we're trying to tax only intangible returns and create an exemption for what's thought of as real economic activity with bricks and mortar out there, or whether we're trying to create a comprehensive sort of minimum tax regime that applies to all income. And I don't think there's a clear tax policy answer there. I think it's a political decision. Economists might weigh in, and one might say that the whole point of GILTI is to prevent artificial behavior of investing offshore with respect to intangibles, and certainly there's political comments to the effect that QBAI subsidizes doing real activity offshore as opposed to onshore, but then there's FDII, and so it's complicated, but I think it's basically just what we want the GILTI system to do. And
Seeing this on the agenda caused me to do the thing I like to do the least, which is open the commentaries to the Pillar 2 rules. Because I was interested in what they said about the rationale for the SBIE exemption. And because I had remembered it described to me as basically a political compromise between developed countries and developing countries trying to permit some level of activity that isn't subject to top-up tax in developing countries. But it actually read basically identically to our policy. And I don't know what you take away from that, maybe.
yeah. Well, no, I'll confirm that this was what could achieve consensus at the OECD around a notion that the minimum tax essentially applies to something other than the real bricks and mortar and payroll generating activities. And lots of countries, including developing countries, felt they need to be able to give tax incentives with respect to those activities that generate a normal return on bricks and mortar investment and payroll.
But I think it was important that you raised FDII because there is a disparity in the treatment of DTIR under the FDII regime, which is basically just taxed at 21%, and DTIR under the GILTI regime, which is exempt. So if you're looking for parity between the two, maybe you would change one or the other.
I think Chip put it well. There's this threshold question of what you're trying to do. And And the TCJA and the GILTI regime were clearly they were not just trying to impose a minimum level of taxation on the foreign earnings of US multinationals. That's not what it was trying to do. It was trying to address highly mobile income and artificial profit shifting and tax the excess returns from that kind of activity and not just impose a minimum level of tax. And the original 2011 Ways and Means discussion draft tried to do that by specifically identifying 936 intangibles. And that turned out to be really just not an administrable way to, even if conceptually that would be a more precise way to do it, given the, we don't just live in a world where intangibles are licensed and a royalty gets paid back. Okay, well, instead of a CFC licensing out the rights and getting a royalty paid back, what if the CFC just does the manufacturing and the royalties embedded in a high profit margin? And that just becomes impossible to do through like specific identification of intangibles if you wanted an administrable tax system. So the sort of 10% excess return became a rough justice way to try to target those returns. The view that returns above that level are much more likely to be related to the presence of an intangible than a normal single-digit return on depreciable property. I do think, as a philanthropic funder, I would love to fund some research. I'm putting this out there. Would love to fund some research into like what is QBAI these days, right? So, manufacturers have lots of QBAI. Well, actually, in my own experience, which is very anecdotal, admittedly, a lot of companies that we think of as manufacturers overseas, they don't do a lot of manufacturing in CFCs. They use contract manufacturers. So they don't have QBAI. They have a sales office. And I'm like, wait a minute, you're a heavy manufacturer, but all you have in your CFC is basically sales and marketing activity, right? And so, the QBAI is in Foxconn, which isn't a CFC. So who does have QBAI? Is it structures? Is it you have to have a distribution center over there because you're selling into that market? Is it the casino in Macau? Is it, this is totally hypothetical, some theme park outside of Paris? In other words, is the QBAI in CFCs a lot of stuff that has to be there and wouldn't be in the US no matter what, because it has to be near the market? And if that's the case, then getting rid of QBAI just makes it more expensive to have US ownership of those assets and just creates an incentive to sell US-owned foreign assets to foreign owners, which I think is a policy result that we do not want. So that's what leads me to say, I would really like to understand the composition of QBAI better.
Yeah, again, I've been away from it for a while, but at one point I thought the numbers were running that, QBAI didn't add up to more than, 15% of total CFC income. So it's not a huge amount of income that achieves territoriality. And so one sort of questions, whether it's serving a purpose or which way you go based on that observation, whether it should be more generous or get rid of it. But it seems to be sort of a rounding error at this point.
And there was, part of it is that it is a narrow base, right? Depreciable property is a narrow base. I mean, I remember discussions about, the banks coming in and saying, well, wait a minute, we make a loan at 3%. That's not an excess return, but our basis in the loan is not QBAI, so we don't get credit. So it's all excess return, even though our margin is really 3%. Some of those things just came down to budget considerations. I remember discussions about certain, like for example, either including like assets that generate active financing income in QBAI, or just exempting, if you qualify for the active finance exemption, just exempting that from GILTI, right? Could do it either way and achieve probably a similar result. And it's like, okay, that's going to cost tens of billions of dollars over 10 years, which Congress didn't have tens of billions of dollars over 10 years to give to a handful of multinational banks. That was not going to be something that they could do. So, but I do think I always have thought there's been an interesting discussion to be had about the base of QBAI. Should it be bigger, which would provide relief from GILTI, although it would reduce the benefit of FDII, right? That there's that asymmetry there. Should land be a part of QBAI? Should inventory be a part of QBAI? We even talked about, at one point, acquired intangibles. Are we disincentivizing U.S. companies from acquiring foreign companies because those foreign companies have, high margins in their local jurisdictions? If there's a Polish company selling to the Polish market at a high margin because they have intangibles, do we want to discourage U.S. companies from acquiring that company because the acquired intangibles, they don't get credit for that in QBAI, now they're going to have more GILTI, right? So I think there's a very interesting discussion to continue to be had about what the base should be. It's a narrow base. I think a lot of that was driven simply by straight up revenue considerations and not necessarily fully developed policy considerations.
Yeah, and I do think that the substance-based carve-outs in Pillar 2 will turn out to be considerably wider and a much bigger slice of income of foreign subsidiaries.
To return to something we were talking about earlier, the treatment of QBAI may become less important in the future because, as more QDMTTs are enacted, more taxpayers will be in an excess credit position, and then the cost of GILTI would be expense apportionment as opposed to actual tax on your GILTI inclusions.
Yeah, exactly. All these little technical issues, I think, are becoming overwhelmed by the fact that everyone's going to be in an excess credit position in GILTI, and you simply will be fully covered with respect to your GILTI inclusions by foreign tax credits, and so the game is all in the effect on expense allocation. Yeah.
All right, so in the interest of leaving some time for the other interesting topics we have, shall we move on to sales and services?
Sure. So this next category and this next recommendation in the paper is really all about considering how, if at all, should we kind of reimagine the kind of conceptual scope of the categories of income that are subject to current basis full rate taxation under Subpart F, and what does the enactment of GILTI under the TCJA, the enactment of FDII, the really large corporate rate cut from 35% to 21%, and then more recently, the ongoing rollout of Pillar 2 around the world. What does all of that tell us in terms of what the scope of Subpart F income should be? We think of Subpart F as being kind of primarily and most understandably passive type income, interest, rents, royalties, dividends. And that's pretty, you could go to somebody who doesn't even do tax and you could explain to them, it would make no sense to allow this sort of incorporated pocketbook abuse where, if, I earned interest, I'd be taxed at a high rate, but if I have my Cayman subsidiary earn interest, the tax goes away entirely. So it seems relatively intuitive that we want to hang on to the sort of truly passive Subpart F categories, the so-called foreign personal holding company income categories. However, since 1962, so since the very start of Subpart F, we've also included some active categories under Subpart F, specifically the foreign-based company sales and services income rules. The reason for including these sort of active categories within Subpart F is that these categories of income, at least in certain circumstances, were viewed as highly mobile and thus similarly prone to being sort of diverted into low tax jurisdictions away from higher tax jurisdictions where there might have been more of a functional connection to the income being earned. So it's If it's the location of manufacturing, fine. If it's the location where the product is being sold, fine. We're not going to pull that into Subpart F income. And on the services side, if it's the location where the services are actually performed, fine. We're not going to pull that into Subpart F. But if you don't have that kind of connection and you have a related party transaction, Congress, way back in 1962, made the judgment that this was a problem, this was a tax abuse, and it was the kind of thing that they wanted to prevent. And so for years and years, it was pretty unambiguous as a taxpayer that you almost always wanted to avoid these rules. There was a lot of churn over these rules. They would come up in the political discussion from time to time, certainly in the early 2000s, in the years leading up to the 2004 American Jobs Creation Act. There was a lot of activity around that. Business community had for years pushed to get these rules repealed. And then there was a lot of argument about contract manufacturing and did the rules as they were currently constructed in the code and regs, did they adequately capture sort of modern supply chains, which are much more complicated than the supply chains of 1962. And so there's been a lot of churn, and certainly from a taxpayer planning and compliance perspective, we spent a lot of time dealing with these highly complex rules. Prior to TCJA, what was at stake in planning around these rules was often the difference between a 35% rate and a very low or even zero rate, which, as Cara said, it's deferral, but it was indefinite deferral potentially, and from a financial statement perspective, it was almost as good as exemption. So it was. You could have argued about whether this should have been a category of Subpart F income or not. Interestingly, other countries basically haven't followed us down this path of defining from the ground up a category of sales or services income that should be subject to a CFC regime. But you could at least understand that there was something at least worth thinking about from a tax policy perspective. TCJA comes in, says, all right, there's no such thing as zero tax of your CFC income because we have GILTI now. It's only a 10.5% rate, maybe effectively a little bit more than that due to expense allocation and foreign tax credit limitations. But we're pulling all of this income in now at 10.5% rate. Meanwhile, we've also reduced our general corporate rate to 21%. And then furthermore, as a sort of incentive to serve your non-U.S. markets from the U.S., we have FDII, which is going to give you 13 1/8% rate, at least as currently constructed. And then again, as I said, we have Pillar 2 coming online, which is going to make it very difficult to get below 15% in any given country. So, looking at all that, what are these categories of active Subpart F income really doing? Well, in most cases, in my experience, taxpayers continue to really bump along as they have. It generally still makes sense to avoid the rules. The difference between, say, 21 and 10.5 or 21 and 15 or however you want to think about it. It's narrow, but it's worth thinking about. Mm-hmm. And so in most cases, we're still going through the churn of avoiding the rules, which turns out, it's very complex, but it's pretty rare that you can't accomplish the result of avoiding a pickup under the foreign-based company sales or services rules, where, the sort of new thing that comes along with, in light of GILTI and in light of the 20% haircut on foreign tax credits, in light of the purely annual calculation for GILTI purposes and the inability to carry forward GILTI basket foreign tax credits, it is often advantageous to affirmatively plan into Subpart F treatment to avoid the haircut, to restore the ability to get foreign tax credit carry forwards. And these rules make it relatively simple to, plan into them. You can accomplish it sometimes through a check the box election, by changing where you're selling something, where you're doing something. And so it seems that the rules are probably not accomplished in terms of preventing US base erosion. They're probably not accomplishing a whole lot. They're throwing off a lot of complexity, a lot of compliance work, and they're creating kind of an affirmative opportunity for taxpayers to use the rules to achieve a certain level of electivity. And to the extent, now, it might be that we don't think that, if you think that the foreign tax credit haircut and the purely annual design features of GILTI, if you think those are bad ideas, then maybe it's a good thing that you can elect out of them. But if you think those are good ideas, then it is a bit of a head scratcher, why we make it so easy for taxpayers to elect out. So I think it's a reasonably clear call. And by the way, it could possibly even be a revenue raiser. JCT scored something similar as such in the context of an earlier package. And so I think it's, as sad as it would be for me, as I know and love these rules, I think it's probably time to retire them. With that, let me turn it over to the commentators.
Can't add anything to that. I think you made the case.
If repealing them would be a revenue raiser, then I think we can just say, bang the gavel and say done, right?
And I'm sure that was not what you were being advised back in 2017.
I don't know that I was involved in any 2017. That doesn't mean that it didn't happen. I don't recall being in any 2017 conversations about the feasibility of it.
Yep.
I do recall years before that when we were working on Chairman Camp's bill.
Right.
We meaning staff, wanted to figure out a way to repeal sales and services income and 956. I think if you go back and again look at that 2014 introduced bill, what you'll see is on sales income, we provided two ways out. One was a minimum foreign ETR of 50% of the U.S. corporate rate. So basically like high tax exception, but 50%, not 90%. And it was 50% of 25% in the Camp bill, so 12.5%. Or if the CFC was in a treaty jurisdiction eligible for treaty benefits. I don't remember why we said we decided we couldn't repeal it, but we could scale it back that much without the potential for leakage. Now, that was in the context of a new category of, intangible income that was in Subpart F. So it didn't have all these other issues going on where you might want to elect into Subpart F, right? So the move, it might be that the move from that form-based company intangible income concept to the GILTI regime with all the different rules on losses and credits and all that might totally change that prior analysis. And what you're saying intuitively sounds feasible. It would be interesting to see if it'd be doable, because I think as a larger goal, it'd be great. It'd be great to clean up Subpart F and really make it a passive income thing.
And the world is just changing dramatically from what it was in 2017. If we're really ending up in a place where it's no longer feasible to shift income into a zero tax, foreign jurisdiction, there just is less juice to achieve.
Yep.
And I'll just also observe that one of the things motivating the high tax exception was to provide taxpayers with an alternative to affirmatively planning into Subpart F in the general basket.
Yep. Makes sense.
I think I agree with your assessment of where we are today. Complicated rules, they're kind of a crude instrument for what they were trying to achieve, which is, I think, limiting U.S. and foreign base erosion through related party transactions. like, as to whether there was a legislative proposal that would have limited them to protecting or policing U.S.-based erosion by limiting the definition of a related person to a U.S. tax resident or a taxable unit that's subject to net basis tax in the U.S. I mean, I think that's the question is like, should there be some form of these rules in the future? It may depend on the rates. Like, it may depend on what the U.S. rate is, what the FDII rate is, and whether Pillar 2 has been successful.
Yeah, that's a great point. None of these, the rates and Pillar 2 are hardly a stationary target. Okay, so just a few minutes on Section 956 before we get to Kim and Paul and their interesting issues. So Section 956, again, much like the topic we were just discussing, highly understandable in a pre-TCJA world. So the pre-TCJA tax system was fundamentally repatriation-based, indefinite deferral until the time of repatriation. Eventually, I'm glad to say that everybody on kind of a bipartisan basis agreed that that was kind of a dumb decision to make your entire international tax system depend on, the act of repatriation. And, one of the good things, in my judgment, that TCJA did was to make repatriation a little less important. Now, anybody who's thought through PTEP issues, there's still plenty to think about. But at least the system is no longer fundamentally repatriation-based. And under GILTI and Subpart F, at the moment that the CFC earns the income, you kind of know how it's going to be treated. And not so much rides anymore on this repatriation or no repatriation decision. But in the old world, the dividend home was the taxable moment. And so if you wanted to make that system work, it seems important to have a backstop, that there might be other ways that taxpayers might effectively repatriate CFC earnings, effectively make those earnings available to U.S. operations, whether that, the simplest would be a loan from the CFC to the U.S. parent, other types of transactions. Of note is the CFC stock pledge rules, where if you pledge more than 66 2/3% of CFC stock to a lender in a transaction that also has certain sorts of restrictive covenants on your ability to dispose of the investment, then that's treated as basically a Section 956 repatriation of those CFC earnings. Given that we decided to exempt CFC dividends, at least for corporate shareholders, given that an actual dividend is no longer taxed, do we still really need this category of a deemed dividend of sorts? I say a deemed dividend of sorts. It's not actually a dividend. If it were actually a dividend, then 245 Cap A would apply. But instead, the Congress was pretty much silent on it, and so we ended up with a backstop with no readily apparent purpose. Treasury and IRS did what they could to make sense of this all, and they basically said, okay, we still have 956, but if an actual dividend would have been entitled to 245 Cap A exemption, then we're not gonna give you the pickup under 956. The issue is, and this is not the most important issue we'll discuss here today, but the issue is that those regs are complicated. 245 Cap A has complications, and in the deal context, the borrowers and lenders still haven't figured out what to do about this, the CFC stock pledge rules, and lenders would like to get more collateral, and the discussion goes that, well, but we got to make sure we don't somehow fall out of bed under these regulations. And so it strikes me that we have this rule at least as applied to corporate shareholders. We have this rule with no evident purpose anymore, and yet it's slightly gumming up deals. Comments from the panel?
Yeah, my sense is, at least quantitatively, in terms of the exposure, the Treasury regs, you fix, 98% of the problem?
Yeah.
What's left is you might trigger some dividend amount with respect to your hybrid deduction account, E&P, or E&P, where you don't have the holding period
Yeah, I think
for the,
Hybrid deduction accounts, extraordinary.
yeah.
uh,
Oh, yeah,
dis-
okay, the
disposition
245 cap A-5 accounts, yes.
Holding
yes,
period
onto that.
issues.
Yeah,
And
and,
there's some concern about.
yeah, holding
aggregate
period
deficits in
issue.
E&P.
Yeah. Oh,
But I think we're only talking about corporate shareholders, right?
Yeah, that
Yeah.
might be addressed in another.
yeah, I've lost track of that one, but yeah, it would be nice to just clean it up unless someone thought that it's necessary to basically backstop the, 246 cap A kind of mechanisms to avoid, taxpayers, doing hybrid financing in CFCs, then somehow getting, avoiding or getting the money back through 956 rather than dividends. But yeah, it seems to me that game's not worth a candle.
Yep. Okay, with that, let's turn it to Kim and Paul. I think Kim first up on income allocation under 951A.
Thanks. I really wanted to spend the next 10 minutes with more of this stuff, but we'll talk about this. 951A was a topic of interest to me because I think it's something that could be fixed relatively easily. It's technical. I don't think it raises any real policy concerns, at least none that I have been told about. And so what's the problem? So since the beginning of the Subpart F regime, we've had allocation rules that allocate Subpart F income, and now they operate with respect to GILTI as well, allocate Subpart F income between a buyer and seller when a CFC is the target. And those rules are old and a little clunky, and they, for reasons I'll get into in a minute, they create a great deal of negotiation in cases where CFCs are the targets of a stock sale. So how do they work? Basically, they say we're going to treat all of the income, all of the Subpart F income as sort of accruing on a daily basis, which is, by the way, the same thing that the PFIC rules do and makes sense if you're thinking about purely passive recurring income. And then they say, okay, when you sell stock, we're going to allocate, the first step, we allocate all that income to the person or persons who are U.S. shareholders of the CFC on the last day of the taxable year in which the foreign target is a CFC. So in a simple example, if you have one U.S. 100% shareholder of a CFC selling to an unrelated U.S. person 100% of the stock, and they sell on December 30th of a given year, then the buyer includes all of the Subpart F income for the entire year, and the seller includes none. But then you have to go to two other rules that ameliorate that kind of weird, I call it the musical chairs approach. The second rule is the buyer is not taxed on income that is attributable, again, on sort of a day counting basis, to a period of time during the year in which the foreign corporation was not a CFC. So in the example I just gave, if the seller were a foreign person, and therefore the target was not a CFC, then the U.S. buyer would only pick up 1 day of accrual. So that makes sense. And then the third rule is that if there have been dividends or dividend equivalents, i.e. 1248 pickups, during the year for the seller's account, those reduce the buyer's inclusion. And that's really where the rubber started to hit the road after the TCJA. The government, quite understandably, didn't like the fact that that last rule seemed to apply literally, and it does apply literally, even if the seller is not reporting that dividend or 1248 pickup in income, because we now have a participation exemption system. Now, I'd point out that, and this is kind of a minor point, but the rule was never premised on a complete closed loop in which all the income were taxed. You could have a U.S. tax-exempt a seller or a foreign seller who was not subject to tax on dividends for some reason. But, and the government knows that. But in general, the idea was, no, wait a minute, we really thought that this income pickup on the seller's part was a predicate for the buyer not having to take the same amount into account. So we got the extraordinary reduction regulations under 245 Cap A, which basically say that if this problem that I've just outlined comes to pass, we're going to deny the 245 Cap A exemption to the seller. That is a very, the 951A in its general design is a non-economic rule. And now we have a rule that's even more non-economic because it's punishing the seller for a system default, a system problem. Now, the government recognized this because in those regulations there is an out. And the out is that if both parties can elect to basically close the year at the time of the sale, and then properly allocate on a closing of the year basis the income between the buyer and the seller, then you don't have this rather punitive result. The paper that's in your book here basically says this shouldn't be elective. This is something that people can overlook, or people have to negotiate and they have to make the election jointly, and you're putting all the burden of this faulty design on taxpayers who may not be sophisticated enough to even realize what's going on. What we should do is just change the code now that we're all sitting down to talk about these things, and have a closing of the books method under 951A, basically the same way we do under 706, I think it's D, for Subpart F income, which is in many ways very similar to what we're talking about. So in the one more second I have, I just want to say that as a group, we talked about this. I think the biggest problem with this proposal that was raised was that it's complex. And in fact, in the original design of 951A, it was understood that what they called at the time a tracing rule, or a true closing of the books rule, would have been more accurate, but more complex, and that's why they didn't adopt it. I must say, I think with all the other changes that we're talking about in this program, going to a closing of the books method is probably less complex. It's just that we're so used to the system that we have now, we think it's more complex. But if you work through it and you think that it's too complex, there's ample authority out there for borrowing from other sections of the code or regulations to engraft some de minimis rules on top of it. So I think the one thing that bothered a lot of us was, if you just had somebody sell, 0.5% of their shares to somebody else, you really didn't want to go through this whole closing of the books thing. And there are, in fact, de minimis exceptions in the 245 Cap A regs I mentioned, which could be adopted for this purpose. But that's basically it. It's pretty simple. It's all in the book, and there's no magic to it.
So this is even simpler. We all know, because we're all pretty experienced here looking around the crowd, that the 958B4 repeal, which reinstituted downward attribution under 318 from a foreign corporation to a U.S. corporation, was broader than was intended, right? They intended it to apply to multinational groups that are foreign-owned and where you have a U.S. sub that partially owns a foreign company. The rest of the stock, or at least more than 50% taken together, is owned by other members of the group. And they wanted to preserve CFC treatment for that kind of jointly owned foreign company. But the bill went too far by repealing 958B4 so that it had the unintended consequence, or at least the resulting consequence, of if you had a 10% shareholder in any of the foreign companies in that chain, including the foreign parent, that company would be, the foreign subsidiary would be a CFC, and therefore you could be a U.S. shareholder in it because you're a U.S. shareholder of, for example, the parent company. And so the income of that second or third tier foreign subsidiary could be Subpart F or GILTI income to you as an unrelated but 10% shareholder to the foreign group. Now that can be good or bad, right? And in fact, at Skadden, we had clients on both sides of that discussion because a GILTI inclusion with plenty of foreign tax credits and not harmful expense allocation can mean you're not paying much tax under GILTI, but you're getting a basis step up. And if you're a 10% shareholder in a company that you don't control, you may actually end up selling those shares sometime. So that could be a net benefit to you. But for other companies where there's not a lot of foreign tax credits coming with the GILTI or Subpart F inclusion or the transition tax, it could be a detriment. But in any case, I think it's pretty clear to most of us that the consequence of having these unrelated U.S. taxpayers who own 10% or more of a foreign company be treated as getting Subpart F and GILTI income from subsidiaries, non-U.S. subsidiaries of that foreign company, just doesn't make a lot of sense. And in fact, getting the information from the foreign company may be difficult because they may not care about the CFC rules if they don't have any 958 ownership of the relevant foreign CFC. So I think we can all agree that we need to fix this. And if we're not gonna just restore 958B4 completely, we need to limit it to attributions within the foreign multinational group. Chairman Brady introduced a technical corrections bill back in 2018 that did that, and BBB had a provision that did that. They both did it by enacting a new code section called Section 951 Cap B, which established two new types of terms. One, a foreign-controlled foreign corporation. So they called it an FCFC. You could call it an FCCFC if you really were literal about it. And then a foreign-controlled U.S. shareholder, or FCUS maybe, I don't know, something. But and it seemed to me that this was overkill, that you didn't need to actually adopt a 951 Cap B. That would be really hard to explain to students when you're trying to teach them, and would just overly complicate things unnecessarily and force the IRS to write. I mean, think of 367B, all right? Now you have CFCs, U.S. shareholders of CFCs. Now you also have FCFCs. What happens when you go from a CFC to an FCFC? What happens when you go from an FCC to a CFC? You'd have to write all those regs to tell you what happens. And you go in and out of U.S. shareholder status. Maybe you come into FC U.S. shareholder status. And it seemed to me it was much simpler. Sorry. There's a much simpler way to do it, which is just to tweak the definition of C at C itself by expanding it to take into account downward attribution within a group when that group owns more than 50% of the stock of the relevant entity, but not where it doesn't. So that you have some situations where you have a technical, what otherwise might be a U.S. shareholder in a CFC, but you're not treating them as a U.S. shareholder because they're unrelated. But if they're part of the 50% group, they are related. And it's just expanding the definition of CFC in 957 and the definition of U.S. shareholder in 951. And I think that's a lot simpler way to do it. Why they did it that way, I've really been digging over the last few years into that, have talked to everybody from Brenda Zent to Wade Sutton, who were all involved in the original 951 Cap B draft. And they tell me they're not sure why they did it. They thought there was some problem. So I could be entirely wrong. It could be that they had to do what they did, but I don't think so. And before the next tax bill just adopts what they did before and throws it in to fix this problem, which is what happened with BBB, let's hopefully have some folks go back and rethink this to see whether there isn't a simpler way to solve the problem. Okay? That's it.
What? I guess so, yeah. Recess.
Okay, welcome everyone from this very long break. My name is Noha Nayari. I'm a tax director at PwC, and I will be introducing our next panel that will be discussing foreign tax credit. There are 2 parts with 15 minutes break in between. And our presenters today are Michael Caballero, he is a partner at Covington and Burling, Ronald Dabrowski, a principal at KPMG, and our commentators are Leila Asali, a member at Miller and Chevalier, Paul Oosterhuis of counsel at Skadden, and Philip Wagman, partner at Cliver Chance. So Michael, I'll turn it over to you.
Okay, well, I'll be extremely brief because Ron is actually going to kick us off to start things. So why don't you dive in?
All right, just to set the stage on the agenda. So 3 basic parts here. For the first 40 minutes in our first session, before there's a break, we're going to cover creditability. So 901 and 903, what is the income tax, what's an in lieu of tax. Break, session 2, we come back. We'll pick up with the foreign tax credit limitation, so section 904. And then we'll close with a kind of special segment on the treatment of GILTI within the foreign tax credit system and what we should do there. So 3 big pieces. A few other items. So we're basically just talking about corporate taxpayers. So this is kind of fully foreign tax credit policy as it relates to corporations. We're happy to take questions throughout, so I don't know, hands, however you want to do it. It's a small enough room. We will, though, try to keep the program sort of roughly on time. And let me just close with, what's the importance here? If you look at the 2020 statistics of income, so the last year for which they're available for foreign tax credits, $137 billion of taxes were reported as foreign taxes were reported as paid. About 65 billion of those were actually credited. And the residual tax, which was a little rougher number, but their estimate was about 35 billion of residual tax on foreign income after the foreign tax credit. So, just for what we're talking about in the scope here and how it relates to the policy, I mean, these are all just huge numbers and kind of interesting how they shape this policy discussion. And of course, this is the 2020 year, so that wasn't a normal year, you might recall. And it's also just the data has not been normalized, right? We've just been living sort of in this TCJA regime, and we don't have anything since 2020. So, I think we'll become more educated as more data and the economists get to take a look at things. With that, let me hand it back to Michael to give us a little framework on the foreign tax credit.
Okay, and just very, very high level before we dive into a little bit more specific stuff. Start out with the purpose of the credit, which everyone knows in courts cite all the time to eliminate double taxation. And now the bad news about this presentation, we're 15 seconds in, and we already have a problem because while everybody says eliminating double taxation, it turns out that that is a very, very difficult concept for everybody to agree upon. And we're going to talk about how to think about it. It's going to infiltrate all of these questions because the system is a very integrated system. But one person's concept of what is double taxation may, in fact, vary quite a bit from someone else's. And we have, obviously, Congress's view about what that means. We don't, or flip it around, we do provide a credit when there's a foreign tax that we think is an income tax, but we don't, for example, for a VAT. But we also have 903 sort of dropped in the middle of this. So just when you decide that you're worried about 2 jurisdictions imposing income taxes, 903 comes along and says, well, if you're doing something entirely different, but it's in lieu of a income tax, that's going to work as well too. So at a high level, and this also feeds into what we're doing with respect to the panel, the 2 biggest pieces of the foreign tax credit system are Section 901, what taxes are creditable, which for US purposes, as said, will be taxes imposed by foreign jurisdictions that are taxes on income. And then the second piece is the limitation. And the limitation is, at least to my mind, probably the most complicated set of rules in the Internal Revenue Code. Part of it is the stakes are enormously high. I don't know what the number is, but the numbers Ron put on the table about the magnitude of the credit, I think are even more stark when you put them against what is the total revenue raised from corporate taxpayers which itself is not a huge number by any means anymore in our system. But 904A goes all the way back to 1921, and it's basically just protecting the US tax base. So if you earn income in the United States, we're not going to let foreign tax credits eliminate the US's ability to impose our tax on it. But if you earn income outside the United States, and more to come on what it means to be inside and outside the United States, not a simple question by any means. But when you earn income outside, the US has ceded the right for the foreign jurisdiction to tax that up effectively to the amount of US tax that it would be imposing itself on that foreign source income. That takes us to 904D, which is a slightly more complicated question about once you decide to protect the US tax base on US source income, when are we going to protect the US tax base on foreign source income? Or another way to say it, when are we going to protect US residual taxation on foreign source income? The easiest one, and obviously we'll talk a little more, is passive income. We're not inclined to give up residual tax on passive income because anybody can move a bank account from New York to London and effectively shift and create foreign tax credit limitation. And of course, the last thing on this list is 904A and 904D, and the entire limitation is a limitation based on net income. And so it's not just important to know where the income is sourced, but really important to know what deductions are allocable to it. Moving either of those needles, gross income or deductions, is going to affect whether within the system we're creating some double taxation systemically or whether we're over-relieving double taxation. And the last thing I'd say, is context is everything. It's very easy to get very specific with all these international tax rules, which are highly detailed, but it is incredibly important to step back and remember the context. A couple of contextual things to think about. One, the structure of the US international tax system is incredibly important, and we're broken down into several papers, but they all intersect. And I was struck by the last panel, for example, and the concept of GILTI and QBAI, and raising the question of, is GILTI really taxing intangible income? And we have this formulaic approach to figure out what intangible income is. But if, I would contend, another aspect of GILTI not really taxing intangible income is the sort of homogenization of tax rates under the GILTI 960 rules, which basically just spreads the tax rate globally across everything. So it doesn't really track whether it's intangible income or a return to tangible income in a way that the Pillar 2 rules would, which is another big difference between the two. But it's one of those moments where, as complicated as everything is we're going to be talking about today, it's unavoidably tied to everything else in the international tax system. And the last thing I'd say just quickly is it really matters what the relative level of US tax is versus foreign tax. In the 86 Act, we lowered our tax rates and the rest of the world followed because we were a giant net capital exporter. Currently today, we're in a very strange place where the US tax rate, at least on GILTI, is 10.5%, which puts us in the middle, maybe on the lower side of the middle when you think about where other jurisdictions are at. Tax rate's very high. If the US was at 50%, we wouldn't have to worry about a foreign tax rate limitation. All the income in the world would be taxed less than the US, right? And so it could all go into one basket and life would be simple. The more the US finds itself in the middle, the more you have to care a lot about the foreign tax credit limitation and all the complexity that brings. So with that, I'll turn it over to Ron to at least start off the discussion about 901 and what will be a credible tax.
Yeah, so a threshold question we have is do we need legislation here? I mean, can't we handle this by regs? And we'll talk a little bit about the regs that were recently promulgated. We had 100 years of stability, basically, in the definition of a foreign income tax. And so, do we need statutory changes? I think, and I think it's our consensus, and again, Michael and I will let each other know when we disagree, but everything's broadly a consensus view. Yes, we do need at least guidelines, frameworks established by Congress in this space. Probably three reasons that are driving it. One are changes in the international environment, and we'll talk, it'll be like the cloud that hangs over this conference for 2 days, but Pillar 2, a large assertion of residence and residual-based taxation. So a big change from where we were. Basically, the rest of the world starting to look more and more like the US, which is kind of a strange development in many respects. Second is Pillar 1 and DSTs, so both forms of market-based taxation. And interestingly, it's not developing countries. This is our major trading partners. So So this is kind of signaling, at least, and it's interesting, the framework in which it arose, but something's a little bit amiss with the global tax system, and market-based taxation is making a comeback. You can argue, at least, that it's a substitution of, basically a politically expedient VAT, like let's impose a VAT on not resident people, as opposed to actually imposing a VAT or a sales tax locally. But that dynamic and how it relates to the federal income tax system is certainly much more important as a development. The third is just obviously the changes in the global economy, right? So extracting value from intangibles has become sort of the name of the game. We talked in the last panel about, it's like GILTI. We will talk about FDII, both intangible based. We've seen sort of the Internet of Everything, software as a service. The means of transmission of value through intangible creation is different, and the different tax treatments are driving different results. And it's probably a time to revisit that, perhaps in the context of the 901 and 903 rules. Second major development was how TCJA and Treasury's reaction to TCJA changed the relation of foreign tax credits. Basically, we moved from using deferral as kind of our first line of defense against double taxation to now it's almost exclusively the foreign tax credit is our means of relieving double taxation. The international provisions and the international changes, Treasury looked at it and decided that really our definition of a foreign income tax and in lieu of tax were not fit for purpose anymore and need to be revised, and did so legislatively. And that was a comprehensive revision, so it's probably worth just unpacking a little bit the highlights, I think, of the changes to Section 901 and 903 brought about by the 22 regulations. So for the 901 regulations, it's the attribution rules. We're looking to the U.S. source and jurisdiction to tax as how we're judging foreign tax rules. Second, and a little more broadly, we lost sort of all flexibility. It's a very rigid code conformity. We've lost predominant character. We've lost normal circumstances as our ways to evaluate foreign income taxes. So again, a pretty stark change from where we had been for pretty much 100 years. Next slide. On the 903 side of things, again, we have attribution looking to U.S. sourcing rules to determine when a foreign tax and in lieu of tax is appropriate and can be applied. Almost as importantly, probably, though, is the creation of a very strong nexus between our in lieu of taxes and what they've termed generally imposed net income taxes. So the local jurisdiction needs to have a generally imposed net income tax. That net income tax has to align with our 901 rules. So no good income tax in the jurisdiction, no good Section 903 tax can come out of that jurisdiction. Second, the close connection requirements basically mean that a 903 tax has to be either enacted with or as a replacement of a generally imposed net income tax. And so basically any new or novel tax just isn't going to qualify. And so, a very kind of tight ring fence around Section 903. Again, dramatic change in response to a dramatically changed environment. So did this approach kind of create issues with respect to both Section 901 and 903? Yes. I think the biggest is probably sort of a cliff effect. Like if you don't have this conformity, it's all or nothing. Like your tax is either creditable or it is not in whole. And that all or nothing aspect is a sort of major source of angst. On top of that is just, I think, the administrability of the provisions. So the code conformity requirement and proving that out, in particular with respect to Section 901, proved to be very challenging. So, and perhaps the most telling part of all of the challenges that the 22 regulations created is they're in large part suspended now. So for Section 901, pretty much we're back onto the old regulations. For Section 903, they continue to apply to particularly target DSTs, but have otherwise been walked back in some of their more controversial aspects. As it relates to, do we need to have legislative changes here, we might be stuck. We have regs that were put out, the regs are suspended. What is the way forward? It seems at least that it would be nice to have a legislative package that at least frame guidelines so that we can move forward with a stated U.S. policy on this matter and not particularly rely on administration to administration to define a foreign income tax, or at least the contours of what we consider to be a foreign income tax or an in lieu of tax. The last item on there, so U.S. treaty policy, as we've seen in the Croatian and Chilean treaties, two big changes that kind of were brought about apparently by the TCJA. But the first is we don't allow an indirect tax credit by means of a treaty. And that is, notwithstanding in a post-TCJA environment, we impose almost all our tax indirectly through the GILTI regime. So we tax foreign jurisdictions mostly through GILTI, but we only give a credit for directly paid taxes. So a real big disconnect in at least in the treaty context, a messaging of blessing double taxation. The second is for direct tax credits. The revised treaty policy is you have to meet the code standards. And this hasn't been advertised too much, and we haven't seen it play out, but there's a pretty major tension here between the definition of covered income taxes in a treaty, which treaties have traditionally told us are good income taxes, and then what domestic policy and what the 22 regulations have told us is a good tax. And so these tensions here might well best be addressed by legislation. So what do we actually do? It might be good to frame it as boundaries and where do we go in the middle. So going back to the pre-22 regulation package and the case law and regulatory framework there is probably as liberal as we're going to get, and it is certainly one approach. The second boundary is probably at the other end, looking at the close conformity to the code with the 22 final regulations. Like, is that where we should go? Or should we land sort of someplace in the middle? And I think most of our discussion here, most of what we recommend is in the context of something in the middle. With respect to Section 901, oops, let me get back. You probably divide the world between resident taxes and non-resident taxes. For resident taxes, so a local subsidiary, in our context, it's usually a CFC that's operating in the jurisdiction, probably need to restore administrability. So getting back to predominant character, normal circumstances is important. For non-resident taxes, it's a bit more complicated. The administrability requirements are still there, and those complexities still exist. But the attribution rule is where the uncertainty lies. It might well be that having tax treaties address the boundaries might make some sense in the Section 901 context. So you have rules that go one way, and then allow treaty policy to fill in that gap. It's actually interesting, we've had a lesson now in the Taiwan tax bill of another way to accomplish a treaty. And query whether the framework in the Taiwan tax treaty, which was a congressional executive agreement, which is bicameral, so passed by the full Congress, and sets up a framework for addressing, in this case, foreign tax credit issues, might be an appropriate means to provide more targeted, negotiated solutions. Section 903, probably more challenging and also more important given the proliferation of Section 903 taxes. In many ways, it's fighting the same old battle, if you would, that we've been fighting, the tension that's been between developed economies and developing economies, residence and production-based taxation versus market-based or resource-based taxation. But again, the stakes are now higher. It might well be useful to have guidance around, and this could be in 901 and 903, or it could be in the sourcing rules, and we'll discuss sourcing in a future panel, but the disparate treatment of intangible value between manufacturing and royalties and services, and we're on the cusp of automation being another differentiator in the delivery of intangible value. Having congressional framework around either conforming or disconforming or providing some rationale for a comprehensive treatment of intangible value might smooth the road in Section 903. Similarly, again, this might be a place where treaty policy plays a role. You can imagine a framework where it's, anything that looks or smells like a DST is just not creditable, and then there's a grant of authority to negotiate on a bilateral basis when the nature of the relationship between our jurisdiction and another jurisdiction, between what we're getting in a negotiated tax deal, makes sense to allow creditability. And we have allowed creditability for, let's call them questionable taxes over the years. And it's been, in the interest of U.S. domestic economic policy. Expanding, codifying that framework might well be appropriate. But there's a lot to discuss here. So let me open it up to first Michael.
Yeah, I would just, two thoughts quickly. One, which is this often gets framed as a sort of a two-body problem, and I think it's a three-body problem, not to diminish what is a very interesting mathematical question. But, people are very concerned about all these novel taxes being imposed, and if the U.S. grants a credit, we're basically shifting U.S. revenue to foreign jurisdictions. But there is, of course, a third person in the room, and that person is a U.S. taxpayer. And so a very important part of any of these decisions is the more you narrow 901, the reality is you're going to be pushing that burden on to companies. Obviously, we push that burden on to companies for other kinds of taxes, so it's going to be part of the mix, but it's just something not to lose sight of. In some ways, I look at it, going back to that point about what is double taxation, I think it's very hard to know what double taxation is, but as someone once told me about progressivity in the code, it's very hard to know if the code is progressive, but we can tell when changes make things more or less progressive in the code. And I feel that way about double taxation. It's very hard to know if the current system is eliminating double taxation, but we can tell whether changes are either increasing or decreasing on the spectrum, and at least be thinking about that because that other taxpayer is in the room. And the last thing I say is digital is obviously the front of this. It is an interesting question. I think we were very quick to criticize other jurisdictions when they impose different types of taxes, but I'm very mindful, and we don't have to look very far, that the US has been somewhat creative in its own taxing systems, whether you go historically, special rules for insurance companies under Subchapter L, or even insurance excise taxes for foreign insurance companies, or whether you look more recently with things like BEAT and CAMT and other things. So even in the US, we've done a fair bit of experimentation. So with that, I would turn it over to the commentators if they have, I don't know who wanted to go first here. Go ahead.
We didn't decide, but I guess super interesting topics. I think one reaction I had was you started out with, it's sort of 100 years of relative stability, and the historical material in your paper is incredibly interesting, going back to 1918 and 1921. But one observation I had was that that there were sort of decades of controversy over what is a tax, which typically in the oil and gas field, distinguishing a payment for minerals, say, royalty from a tax. And this sounds like a simple issue, but sort of spawned, as I said, kind of decades of controversy and also legislative changes. And legislative changes, when I look at them, they sort of come from like every different direction. Like this issue was attacked in so many different ways, some of which was creditability and some of which was actually the limitation, which we're going to come to later. And it got me kind of thinking, well, and the sort of issues are under consideration are on this slide, but how well can we articulate what the problem is right now, if there is a problem? And, is it, do we need to jump to designing a foreign tax credit system that is kind of ideal for all circumstances? Or is there something wrong right now that we want to solve? And whether it's DSTs or something else, I feel like everybody talks about it's DSTs, and that's why we had these 2022 regs, but the regs went too far. So I don't know whether there's consensus about that narrative or not, but it's kind of one way to think about this problem. Is it something kind of, I don't know about narrow, but is it something we could target, that we could like wrap our heads around, or is it a big issue that kind of requires us kind of to rethink, maybe to, Ron, your point about the sort of ends of the spectrum, like that it might like help us land somewhere on this spectrum.
Okay, I'll go next. The situation with 901 reminds me a little bit about what happened in the 86 Act with 482. They added a sentence that didn't really change much, but then they gave legislative history that kind of instructed Treasury to move transfer pricing in a certain direction. And it seems to me Congress could do the same kind of thing if it chose to in 901. To go through the list here, restoring predominant character would really, I think, help Treasury because the dilemma Treasury had, right, was predominant character is really a hard test. I mean, if you're in Columbia and you're limiting deductions for below-the-line expenses to 15% of your gross income, is that big enough to affect the predominant character? That's an empirical question that is very hard to come to a conclusion on. And Treasury and the IRS assume taxpayers would always say, no, it's not a predominant character, and therefore the burden was really on Treasury. And that's difficult, understood. But unless you're going to adopt kind of a rifle shot approach and go after the incremental foreign tax because of some of these deduction disallowances, which, by the way, I've elsewhere written I think we should consider, but that's beyond the scope of this exercise, then it might be good for Congress to say just stick with the predominant character test, because nothing else really works unless you do a rifle shot approach. Treasury struggled so much with safe harbors, and yet they couldn't get every situation where a country disallowed some deductions but didn't want to throw out the entire tax just because they disallowed certain deductions. So Congress could put Treasury out of its misery, if you will, by readopting the predominant character test. On jurisdictional nexus, that's an issue. Do you like destination-based taxation or not? Treasury clearly didn't. And so they adopted jurisdictional nexus rules. Congress may not like it either, and they may want to say, limit the income tax to something that has a jurisdictional nexus. Doesn't have to be our rules, but something that is not destination-based. And the same with UTPRs. I mean, we've had debates internally about whether UTPRs that are net income taxes, they're just on a portion of the income of somebody else, whether that should be a creditable tax. Congress may want to say something about that. So I think on 901, there's plenty of things that Congress could do if they wanted to. Some of it could raise revenue, some of it could lose revenue, but it could help clarify things. Section 903, to my mind, is something that they really have to focus on. Not so much the in lieu of taxes that are in lieu of residence taxes. So insurance taxes for resident insurance companies, or mining taxes on mining PEs where they're in lieu of a net income tax. But it's revenue, what I call revenue taxes, what most people in the income tax world call withholding taxes. But the withholding taxes are revenue taxes. There's no expenses allowed against them. And the justification for them, has varied over the years. If you want to read a lot about it, I wrote something about it from a Tillinghast lecture that was in Tax Notes in January. But it's a growing phenomenon now in services. It's always been there for royalties, and it's a growing phenomenon now to have withholding taxes on services. DSTs are a form of withholding tax on services. Most of them are not creditable because they don't meet the requirements of 903. And many of them are designed not to be income taxes because they don't want them to be subject to tax treaties, the countries that are enacting them. But nonetheless, services withholding taxes are a problem, or at least a phenomenon. And Congress, to my mind, should weigh in on whether or not we want services withholding taxes to be creditable, because you look at what's going on in the UN today, and there's clearly a growing climate for less developed countries to impose services withholding taxes, arguing that the service recipient should have some of the revenue from providing services cross-border. And so many services can be provided cross-border. I mean, when Skadden writes an opinion for a client in Egypt, we don't need to be in Egypt to write that opinion, right? We can provide the service remotely. And Egypt might say, well, we should get some of that income, but we're not going to allocate net income there. We're going to just impose a withholding tax. To my mind, there's a real question of whether that's an income tax or whether that is a revenue tax, like a consumption tax or like a tariff. And if they put it in their income tax rules and describe it as in lieu of, in some way that it has a close connection, it's probably creditable in the United States. If they describe it as a tariff on services, it's obviously not. And should that really be the defining rationale for whether something is creditable or not in the United States? Because if it is, there'll probably be a fair number of people in the room who are hired by foreign countries to help them do what Puerto Rico did back in 2010 and design a tax, a revenue tax on foreigners that meets the criteria for being creditable. So, Phil.
Just to add a few thoughts to that. First is when we see a short statute that stayed the same and more or less worked for 100 years, I'm sort of a little tentative about, a statutory fix, at least in the case of Section 901. So although the predominant character test seems to have worked pretty well, all things considered, and although the new regulations seem fairly rigid, as is discussed in the paper, I don't know whether a statutory fix, as opposed to just kind of a regulatory reset, is necessarily likely to lead to an improvement. I think the one novel issue in particular, though, that the 901 and 903 regulations address is whether there's a jurisdictional nexus requirement that is sort of within the notion of an income tax in Section 901. And we've had discussions about that within our working group. I think that could be a basic question that it might be useful for Congress to address, just because one question would be whether you just scrap the concept altogether. At the other end of the spectrum, you could stick with more or less what's in the 2022 regulations, which is almost a mirror of what's in the US code, or whether even if it's kind of arguably hubris to sort of say that we've devised the perfect jurisdictional limitation, whether there should still be some limitation, at least, for example, for something like a UTPR. So that would be, I think, one place where clarification might be helpful. The other point that I'd make is just to say that when you add Section 903 into the mix, if there is not a jurisdictional limitation, then it seems that it would be, as Paul has suggested, fairly easy to devise a tax that would satisfy the requirements of Section 903 as an in lieu of tax, and thus, again, absent congressional action, would be creditable. And maybe, as Ron suggested, since this is a knotty set of issues, one kind of way to address it incrementally would be through treaty policy or through something like the approach with Taiwan.
Well, one thought, and I think it sets up a lot of what's going on here, and maybe ties back. Oh, I'm sorry, please.
Yeah, it's coming.
I just want to say, I was struck by your confidence in Congress. If George were still here, I don't know whether he is or not, he would tell you how many new members of the Ways and Means Committee there are since 2017. It's a surprisingly large number. And the Finance Committee is not quite as new, but they're pretty new. And as George said in the earlier panel, what Congress cares about are individuals, pass-through entities, estate taxes, and they don't care about international tax, although I suspect they'll care about it if they're in a reconciliation and they need a little money to make the reconciliation work. And so, just take the predominant character rule. So the statute now says predominant character. And then take Paul's question about services. Well, is the predominant character of a royalty, of a withholding tax on services a payroll tax or an income tax? There is no good answer to that question. I think there's a pretty good answer to the fact that DSTs are more like excise taxes or value-added taxes than they are like income taxes. UTPR, I've got a jurisdictional nexus rule. It's a horizontal relationship instead of a vertical relationship, where quite common that vertical relationships satisfy a jurisdictional nexus test. Does a horizontal relationship satisfy a jurisdictional nexus test? Congress will answer that question one way or another. If you make them, I suspect they would say, oh, those are not creditable because we hate them. So I think that one has to be a little careful here in overreacting to your distaste for the first draft of the foreign tax credit regulations that came out. But that's just an observation.
Well,
Yeah, I want to endorse Philip's and now Michael's caution about pushing things to Congress. But two quick points. One, regarding the Chilean and the Croatian treaty, the United States has never accepted that Subpart F is subject to treaty limitation. And that is why there's no indirect credit provided for. And I think that's technically the right answer. And we can take that offline. But coming back to treaties, I think there is a lot of additional thinking that is required about the Taiwan legislative treaty approach. It has deep, deep flaws that have not been floated. And I think we really should give that a lot more thought before that moves forward.
should we?
Real quick, I think there may well be a role for Congress here, but nobody's mentioned the role of the IRS. Many of us remember that all through the 50s, 60s, and 70s, I don't remember all of them, the IRS ruled routinely on the creditability of foreign taxes, and then it said no. I don't think IRS can rule on all the multiplicity of taxes that are out there, but there probably is a role. The India dividend distribution tax, the Japanese inhabitants tax, if those could have been clarified with IRS rulings, I think it would have been very beneficial to the government and to taxpayers. So there may be a role for Congress, but I think if Congress endorses the fact that after a 40-year gap, the IRS can look at these taxes in appropriate cases, that would be a big win as well.
Well, maybe a couple of reactions, if it's okay, and not to tackle all of them, while I'm really interested to do so. On the IRS, I think there is a role, and I would separate it out, though. Like, I think more guidance in the space is important, especially the more you tighten up the rules, the more you need to provide guidance. That feels different than the question, which I think is getting out of like where the line is for me. Like, Paul's example is one good example of like, what do we think? This is going back to my point. What is double taxation? Like, do we care about, or do we think it's an income tax when a lawyer provides legal services in Egypt, whether they just do it over the phone or not? Personally, they shouldn't be taxing that, but that's a self-interested view. But no, but genuinely, I think that's a question people might disagree about. And how do you feel about it, especially when you add technology, which is obviously the DST world on the side, but as we learned in 2020, lawyers not only can do that over the phone, they can do that being visually present in the room, and in fact, increasingly are doing so. And where is the line? I don't think you would question, Paul, that if your lawyers fly into Cairo and hold meetings there and stuff, that people in Cairo may say, well, we've got activities in country, we're gonna tax that. But if instead they show up digitally in what might be a very similar experience, where's the line? So I think that's.
If I can just respond to that.
Yeah, please.
But presumably their tax when you go to Cairo is a net income tax. So it's allocating the salary of the associate that's there and taxing the net income. Whereas what they're doing with the remote is taxing revenues. And there's a difference between taxing revenues and taxing net income, not as bright a line as maybe we would like to have, but there is a line you can draw between them that helps you decide whether you want revenue taxes generally to be creditable if they have the rubric of income tax associated with them rather than being called a tariff or an excise tax.
Yeah, well, and I think, but if they could get it right, you could see where you start to approximate.
I'm okay with net income taxes applying to non-residents. I'm not okay with just any old revenue tax applying to non-residents. That's basically.
Although we have forever, and our withholding taxes were traditionally 901 taxes, and then 903 stole them at some point. But
in the 80s,
it's kind of a
no, that's right.
What
that's
the
right.
norms are here, and what are our norms, and what's the universal norms. Yeah. To Michael's point on predominant character, I totally get the limitations on it. I would say, like, Section 901 seems to be a place where historically predominant character was, and that might make more sense. 903, I think, is just a lot harder and needs a lot more customized solution. So I wouldn't go predominant character across the whole.
Well, the only thing I would say, especially on pushing to Congress, two things. Yeah, just one. I share probably a higher level of pessimism than you do, but I am heartened by the fact that there are a lot of technical people who are not those actual new members, right? Who, whether it's the Treasury staff or the Joint Committee staff, Senate Foreign Relations, Senate Finance staff. So that will help, I think. But the biggest reason why I think we propose it, just cards on the table, is this concern that we're in a little bit of deadlock here, where Treasury put out regs. They have a lot of problems. They've walked them back. Quite frankly, they have authority issues kind of up and down those regulations, which are a different thing that may not be sorted out for 4 or 5 or 6 years through litigation around them. So there's just a lot here. And so some of this is born of the fact, like, do we need something to help everybody get out of the box? Because I don't want to suggest that those aren't incredibly real risks or shortcomings of turning over something to Congress. I mean, for my sake, if you just go back to where we were 4 years ago, that would be a relatively straightforward process to do, and one I think I would support, but I don't know if everyone would. But anyway, but I think your comments are are quite legitimate concerns. Anyway. Okay.
Part 2 of the foreign tax credit discussion. Can you hear me now? Okay, we will be taking 10-minute break and we'll be back at 3:15. Thank you.
That the exciting stuff is coming up next. So.
Second session, we're going to focus on the foreign tax credit limitation. We'll also talk hopefully about expense allocation if time permits. Also a little bit about the interaction of the foreign tax credit system with the GILTI rules. So kicking off on the foreign tax credit limitation and just building a little bit on what we discussed before and trying to level set. As mentioned, there's two big components to 904. It's artificial, I think, to think about solving double taxation by focusing on one or the other. I mean, they're operating in a very integrated fashion, although 901 seems like always the starting point, but 904 and 904A and D are really critical. As mentioned, 904A is protecting U.S. tax on U.S. activity. It goes all the way back to 1921. And it was quite literally, if you read the legislative history, people were like, we used to have this rule that was a jurisdictional nexus rule for a couple of years. And Congress decided that was a really bad idea because other countries had high tax rates and they were wiping out U.S. tax on U.S. activity. So they got rid of jurisdictional nexus and they introduced what we know as the foreign tax credit limitation, essentially unchanged under 904A. As much as 901 is the same, 904A is the same, going all the way back for 3 less years. It's interesting, this concept is a fundamental principle everywhere. It's sort of this sense of residual taxation versus source-based taxation. While people have solved double taxation in different ways, it has at least, for the last 60 or 70 years been bedrock principle that every home country is entitled to tax activity in their jurisdiction, as well as even source-based taxation for foreign multinationals operating in their jurisdiction. 904D is where things really get complicated. 904A is relatively straightforward. It seems like the U.S. should have the first bite and maybe the only bite at the apple in activity here. 904D is asking that question, as mentioned before, when are we going to protect residual taxation? This is foreign income where we've already said foreign jurisdictions can tax it as much as they would like, and we will cede complete U.S. tax jurisdiction on all of it. And the question just then becomes is, when are we going to still protect that residual taxation, getting to that first bullet about cross-crediting, where, for example, maybe one jurisdiction is not fully taxing that income as much as it might, but another jurisdiction is overtaxing some other foreign source income. And in our current system, those high taxes and low taxed income might blend together. I put cross-crediting in quotes there because I think it's taken on a negative connotation. Like anytime there's cross-crediting, there's something wrong with the system. I would contend quite to the opposite, that in fact cross-crediting is actually the system working well. You also hear from time to time that the platonic ideal of a foreign tax credit limitation is a per item system, so that if you could do every single item individually, basketed by income and credit, that would be the optimal system. I would contend that not only is that not practical, which even the people who advocate it would concede, but in fact it's, I think, deeply flawed. And I think aggregating income is something that we actually should be doing, which doesn't mean that we should be aggregating necessarily all income, but there are very legitimate reasons to do so. And for me at least, without getting too deep into it, I think one of the questions you have to ask is how much do you care about what a foreign jurisdiction has decided to do with its tax system? And jurisdictions can do different things. They could have higher corporate income tax rates, or they could have higher withholding tax rates on dividends, or they could tax debt capital more through interest withholding tax or less. I mean, those are all part of their tax system. How much does the US system want to get in and change the results and potentially change the results from one jurisdiction to the next? Or is it a better approach to be thinking kind of more broadly across how they have collectively put together revenue collection in the system on the activities of US multinational companies? So, policy considerations, this I felt was some obligation to tie back to our paper because we were sort of free-forming a little bit here, but all these are in the paper. There's so much that can be said about all of them. Some of them we've already talked about, like just macro policy considerations, where the US rate is, where the foreign rate is. I would say it would be great to have a foreign tax credit system that works in either environment as rates go up or down. As we learn TCJA, we put ourselves in a very different place globally on our corporate tax rate. Ideally, our rules will continue to work if that changes because, as we know, TCJA itself has a built-in rate change, and 2025 may be a moment when we see even more significant changes. Thinking about the U.S. international tax system, how it's changed, how this all fits together. Competitiveness, which I feel like 20 years ago at times was taken more or less seriously, depending on one's political perspective on this, has generally been accepted. And I think you can even look at Pillar 2, where the world has sort of come around to this sense of it's important for there to be some minimum level of taxation globally in order to protect the competitiveness across all lines. And of course, other considerations, just investment decisions, not too different than any other question you're going to have in the world of tax policy. Then we have these additional policy considerations, which feel smaller, but given the complexity of the rules and stuff, are quite real. Compliance costs and administrability are very real in the foreign tax credit space. I think everyone's going to find that, or is finding that out with, for example, Pillar 2, where the entire world, after having gone territorial, has now adopted the U.S. foreign tax credit system, but adopted it on a per-country basis, which, as I think we would learn if we adopted it here, that's a challenge. And even for the U.S. to shift from our system to that would be hard. I think other countries who've lived in a world of territoriality, it's going to be a real administrative challenge for them to make that. Branch sub-parity, again, and that's just short form for treating branches and subsidiaries consistently for U.S. tax purposes. I think it also stands as a bit emblematic of a general approach to tax policy of trying to write rules that produce similar outcomes without regard to things where how one organization chooses to operate versus one next door, in part because self-help gets people there. So why do we create a system that forces people to undertake self-help if we can just write rules that provide equivalent answers for those taxpayers? The role of international norms, I put it in BIDL. I find BIDL interesting because it's often cited for this idea that we give credits for an income tax in the U.S. sense, which of course the case actually didn't hold that at all. It's not a 901 case, it's a 905 case. But the concept is really important that historically, we really look to what the U.S. thought was a foreign income tax. We look to the U.S. sense of what was source in defining when we were going to allow people to take credits. And clearly, especially in the 2022 regs and the preamble, just an increasing focus on what is the world doing in how we think about what our foreign tax credit policy is in the United States. And the last thing is just revenue, which is just on there. We're not going to talk about revenue, I think, as general as policy, but going back to Ron's numbers, the numbers are big. They're very big, and they're very big in this space as well, too. Not just what taxes are going to be credible, but I would contend, in a world where if I'm remembering the numbers you quoted, around 65 million of taxes are credible out of 130, the limitation is doing a lot of work in the system. A lot of work in the system. So, structurally, what are the choices? We have the pre-TCJA system. And there were a lot of pre-TCJA systems, but we'll talk about the most recent from sort of 86. We had multiple baskets, but even when the baskets were collapsed in 2004, effective in 2006, it's generally been 2 baskets for everyone, even though we had 9 baskets for a significant period of time. And most importantly, all active business income was all aggregated for purposes of limitation. Post-TCJ, we changed that. We now subdivide active business operations into 3 separate baskets, and we do so, depending on the structure through which you earn it, in what is, I might contend, a bit haphazard way. You earn income through a branch, you're in the branch basket, and we'll get to hear about that shortly. You earn income through a subsidiary, and you end up in the GILTI basket for the most part, but Subpart F income also falls back in the general basket, and strangely coupled with low tax royalties, interest, and things like that, which I think is more just a historic anomaly that sort of fell out of things, although that principle of subdividing active income is at least a novel one. At no point in the history of the U.S. have we ever done that other than on a per-country basis. Although, so we've got that, we could also look at a per-country limitation. Obviously, that's what Pillar 2 is all about. The U.S. has come very close to enacting that in recent years, and the U.S. spent a number of years doing that. I think what happened under former law in per-country is very different than what happened today. And in fact, the way the rules worked, in many cases, it was not a significant impediment to have a per-country system. And in fact, the per-country system in the end, which also was an elective per-country system, was done away with because it was costing U.S. revenue, because people were able to segregate losses by electing into a per-country system. So I think all of that has changed, and it's something to be mindful of. You know, go back to the early days, a very interesting fact about the indirect credit is it used to work at one tier. And the reason it worked at one tier is because people had one tier. The days of one-tier foreign corporate structures have long since been left behind and stuff. So the world's gotten more complicated, and not just as 902 went from 1 to 2 to 3 to 6, and now unlimited. And then this last one is high tax, low tax. You could read a very long and uninteresting article that I co-authored about shifting to a high tax, low tax in lieu of a per country system, which would basically separate income on a basis of a high tax or low tax. That system is pretty flexible. You could dial it up in a way that it literally operates as per item, although as I suggested, I would not recommend doing that. Or you can dial it down, and by doing that, I mean setting what high tax is as equal to the US tax rate. If you set it somewhere below the US tax rate, but somewhere along the line, maybe you set it above 15%, maybe you set it above 10%, you can allow reasonable cross-crediting among active businesses in typical high tax jurisdictions while segregating low taxed earnings, presumably from intangible income, in a separate basket, much like we do today and have for a long time with the passive basket. So that brings us to when should we protect residual taxation? I mean, those are the structures, but some of it, going back to what Layla was talking about, what are we trying to solve here? And it's pretty easy to say we want to protect residual taxation on passive income. We've all agreed to that. We've been doing that since 1962, at least in the first instance. There's some other quirks. Rate benefited income like GILTI, you might think we should separately basket. We do it today and have to, because we don't have a foreign tax credit carryover in GILTI, so that's one necessary feature of it. But it also means that when you lower the rate on GILTI, and therefore you presumably have more excess credits, those excess credits can't affect other non-rate benefited income. And so it's just something to think about. If we're going to provide a rate benefit for income, do we want to, as part of that package, limit that rate benefit to just that category of income or have some spillover effect? Because the mere fact of a rate difference doesn't require a separate basket. In fact, we know that because since 1976, we've just computationally solved that problem for capital gains in a way that works just fine. But GILTI introduces a new problem. Intercompany payments of royalties and interest is on there. Paul, I think, will speak to that. It's an interesting topic. Some of it, I think, depends on whether you think those are really separate items of income and they should be separately basketed, in part because they're always low taxed. For my sake, at least, those are income that are basically part of the overall return a business earns from its investment in a foreign jurisdiction. And for that reason, we've always kept that together. Before we had the look-through rules in 904(d)(3), we didn't need look-through rules because all that income was already was all basketed together with dividends and other active income. When we separated it out, we immediately put related party interest, related party royalties in the same basket. But it is a big revenue stream, and in particular, intercompany royalties feel a little bit different than you might think about interest. Whether I fund my subsidiary with debt capital, equity capital, maybe aggregating that return makes more sense in a way that intangibles, we've got actual assets sitting out there, we have expenses developing intangibles. Maybe it's a more complicated question. And so with that, as I went one too far, I'll pause. I think those are the options. Those are some of the high-level considerations. I'll turn it over to Ron for his thoughts before flipping it to the other commentators.
Yeah, just to probably stir the pot a little more for our discussion. I actually find it interesting. This has been something of a journey, but the notion of benefited business income versus other business income is pretty interesting post-TCJA. I mean, the big buckets of foreign source income we have are branch, GILTI, or FDII. And two of those are benefited. And within the bucket of FDII, we also have royalty sourcing, which is something of a benefit as well. And so when you have the code giving benefits to classes of income, cross-crediting becomes another, should we add a benefit? Or, as relates to, for example, branch income. I'm a lot more, I guess, having gone through this process, amenable to the separation that ultimately came out of TCJA, because I think there is a policy question of how much benefit is enough when we have kind of fighting priorities. The second stirring of the pot, the whole GILTI look-through I find fascinating. I view the world more as Michael does, that having GILTI look through, so a payment of interest or royalties from a GILTI environment into the U.S., should retain its GILTI character and should be eligible for cross-crediting. I think it's all just like virtuous behavior. We are, keeping our IP onshore. We are deploying capital in the form of debt offshore. We are creating deductions that reduce foreign tax. All of this seems good to me, and I think it should be encouraged. But there is the other side of the coin that I think Paul will get to. So with that, let me open the floor.
Go ahead on look through.
Sure. Well, yeah, a couple of overview things first. I mean, we do have a foreign tax credit system, which is different than an exemption system in that we are asserting a residual right to tax foreign income, right? And so there's nothing wrong with slicing the pie in ways that are administrable to raise some revenue from applying our residual tax to some foreign income. The question is, what's practical? I disagree with Michael fundamentally that a per item limit is fundamentally wrong. I think it's practically wrong. But in any case, that we all agree we're not going to have a per item limit. A high tax, low tax basket limit, which you have to be careful what you wish for, because if you had that kind of a system, you could say, for example, that in the UK, we're going to divide their income up of a UK affiliate between its patent box income and treat that as being low tax income and its non-patent box income. And the 861-20 rules would tell us how to do that. So it's not like it would be any more complicated than what our system tells us today. So be careful what you ask for if you think a low tax, high tax might be better than a per country, for example. A second point, I've never been really that big of a fan of the per country limit and still am not. And I really think if we want to be Pillar 2 compliant, that we need to do it. If we don't care to be Pillar 2 compliant, maybe it's not such a difficult thing to stay away from. But I do care about the difference between foreign taxes on CFCs, foreign taxes on branches. We can talk at some point about the difference between GILTI and branches, and foreign source income that is earned directly by U.S. taxpayers not connected with a PE. Those are income that are either subject to withholding tax or not, but they are presumably, in most cases at least, being deducted in the foreign country. And where they're not imposing a withholding tax, the foreign country is assuming we have the first right to they're allowing us to have the first right to tax that income. And so it doesn't have to do with whether it's business income or not passive income or what it is. It's who has the right to tax that income and why we should allow cross-crediting against income that we have the first right to tax: interest, rents, royalties, the look-through rule, for example, or active basket royalties and interest. Why we should allow cross-crediting of net income taxes on business income that is in a jurisdiction with our own income that's earned by U.S. taxpayers directly puzzles me. We treat it as foreign source only because of the history of allowing withholding taxes. If we never had withholding taxes, we would never treat them as foreign source, interest, royalties, rents, because the activity, at least for royalties and interest, is in the United States. By definition, you don't have a presence abroad. And so we have this historical, I call it an anomaly, but fact that we have had withholding taxes on these things, and we have agreed going back, almost 100 years to give a credit for those taxes. But that doesn't mean we shouldn't segregate them from from the income of CFCs that are taxed and the income of foreign PEs that are taxed on a net income basis. It's not a hard thing to do. It's not administratively complicated. And it doesn't have to do with the nature of the income as being business income or non-business income. It just has to do with the fact that, but for withholding tax, it's allocated internationally to us to tax. And the revenues are large. The revenues from royalties and interest that are in the general basket is a big number. And so if we were to, for example, allow the look-through rule of 904D3 to apply to GILTI so that all the GILTI excess credits that everybody's been talking about today could offset the royalty and interest income, that I tried to put a line in the paper that said if that had been done in 2017, it would largely have offset the revenue raised by GILTI. But they took it out, everybody took it out because I couldn't prove it. So, but I think it's true.
There is that issue.
Yeah.
I think it's true.
Well, a couple of thoughts on that. And I took it out because I think when I ran the numbers, it gets down to about 500 million. But that's a separate. But if we come back to a couple thoughts. One, and this is an area Paul and I have disagreed about for a long time. I think when you talk about historically, it's a fair point. I don't know where the right answer is on that, but I will say a couple things. One, I don't think we do have first right to tax that stuff. And in fact, we've always treated it as foreign source. So by definition, we've always allowed people to foreign jurisdictions the first bite of that. And maybe that's a mistake, but it's definitely the way that we have always treated it, and very much the sort of fabric of how the U.S. system works. In fact, on the outbound, we are very happy to assert the first bite on dividends, interest, royalties at withholding tax rates that, in my experience, are vastly higher than other countries. And so there is a sense of parity, at least I think, that one needs to think about. As far as it really active earnings or not, I think historically it's always been recognized as active earnings. If you go to 62, which when they first separated out interest, they immediately said, well, we're going to have a separate basket for interest, except related party interest. And in 86, when they created and expanded the passive basket, not just for interest, but royalties, rents, they immediately said, we're going to have a look through to that. And I think that is born of the fact that these are intercompany items. I mean, we basically have intercompany interest, which some people would argue is not even interest, but we'll leave that alone for today, or intercompany royalties. The actual income has actually been earned outside the US or earned directly by the CFC, and whether that net revenue shows up back in the US through dividend or the return to debt capital or the return on the intangibles used by the business, I think at least there's a good argument that that's part of the active business income of a
But that's
multinational.
not the question. The question is, if it's leverage on your German corporation, the German treaty says we have the first right to tax that interest income. It doesn't matter whether it's active business income or not.
No,
it's a matter of how you divide up the relative income flows between the two countries.
Yeah.
And that treaty says we have the first right to tax that income. They don't have any right to tax that income. So why shouldn't we tax it? Why should we allow credits to offset it?
Because, and I'm glad you brought up treaties, because the exact reason why we have that is because we lower withholding taxes in our treaties to ensure that when the foreign tax credit system operates, we don't have double taxation. And we routinely tell countries, if our foreign tax credit system already adequately covers and eliminates double taxation because your corporate tax rate and your withholding tax rates are below the US, then we don't need a treaty to eliminate double taxation, so we're not going to negotiate one.
I read Michael's article to say that historically, passive income, the treaties got rid of withholding tax because passive income is better taxed on a residence basis than on a source basis. And so it had to do with allocating the right to tax to the residence jurisdiction rather than the source jurisdiction. Now, I don't know, maybe you disagree with Michael.
I will say I misspoke, but I think it's important because the other thing I would say about this is, of course, not only I think is that in fact the case, but all of the treaties we have, although we have two very new treaties, have been negotiated in an environment, which was an environment 904.3D applied, or when we didn't need 904D3, because those are treaties that predate all that. We have no treaties that have actually been negotiated and debated this question. So every treaty negotiator who was sitting at the table was sitting at a table, negotiating with the country, giving up, requiring them to reduce the rates on withholding taxes on interest and dividends and royalties, all the while knowing that they obviously weren't doing it so that we could tax it, because they were aware of the look-through rules sitting there. And in fact, they were so committed to it that they were willing to forego the withholding taxes on interest and royalties leaving the United States in order so that our US multinationals would not have double taxation, because that would create limitation for them in the United States. Or at least that's how I understand it from being on the inside and negotiating treaties. But other people may have different views, and of course, treaties have been negotiated by a lot of people over a lot of years. But again, I don't want to, that's one person's view, and I don't want to diminish, and as I say, to me, interest is straightforward, because I could fund my subsidiary with equity or debt. All we're really talking about is an interest deduction. Royalties get interesting for me because there are expenses that created that intangible asset, and how we allocate those expenses, how we source the royalty. There's a lot more on the table there. And I think there's a place where Paul and I, at least, our disagreement is, closer, and there's just complexity. And the last thing I'd say about it is, if you think of revenue, you're right. I think you're right. It is easy to do, and it would raise revenue. I would just ask the question, should we, at least if the North Star is eliminating double taxation, raising revenue isn't probably part of that North Star. Like the North Star, we should figure out policy-wise what we need to do to eliminate taxation. In my sense, although this is kind of foolhardy getting back to our Congress, if we want to raise revenue, we should raise rates, but we know how well that goes and stuff. But name it. But that's sort of how I think about the look-through question.
One final comment.
No.
Don't
limit yourself to one.
Michael and I wrote an article, Michael, when it was at 2002, on if we were to have an exemption system, how would you draft it? And one of the things we mentioned in that article was that every country back then that had an exemption system doesn't apply it to intercompany interest and royalties that are earned by their taxpayers, and that therefore, if we went to an exemption system, we would no longer be able to cross-credit the taxes on the earnings of CFCs with the royalties and interest earned by U.S. taxpayers, and that could be a major reason why you wouldn't want to adopt an exemption system. My point of raising it is just that it would be ironic if our tax system, by allowing, say, GILTI credits to offset interest and royalties earned directly by U.S. taxpayers, would make us more generous for taxpayers than an exemption system.
Well, I think it's a good point, and the only way I respond to that is, and you can go back to, I think Harry's name was raised before. I think there was work in that space about whether we have a net negative income tax on our foreign source income.
Right.
For those
Yeah.
reasons. And that's very legitimate.
Mindy, you're going to blow the whistle here.
Yeah. I want to make sure our other commentators have a chance.
Who wants to dive in after that? Wow. Pick up the same topic.
Well, I'm happy to chime in, but possibly less controversial. Just picking up on a couple of the points. As far as the possibility of switching to per country, the main justification I could see for doing that would be if the U.S. moves toward adopting Pillar 2, given the complexity that's involved. And I think one of the points that I think we talked about, and which this slide alludes to, is whether a high tax, low tax system could accomplish sort of many of the same basic goals as a per country system in a simpler way, and in a way that potentially, picking up, Michael, on a comment you made a while back before the gloves came off, could potentially be automatically responsive to changes in the U.S. tax rate. So that's there are other mechanisms that we had also talked about, but that would potentially be a relatively straightforward one, and one that you could trace sort of historical antecedent to the interest basket and the passive income basket, potentially, if you view those as a proxy for mobile low-taxed income, and really sort of protecting the U.S. against erosion of the taxation rate on U.S. source income. If you view everything as being mobile low-taxed income, kind of like in our first panel, then you could potentially justify it on those grounds.
Yeah, I think I would agree. I think The high tax, low tax is really per country light or more simplified way to do it. And so it has a lot of merits because I think it's simpler. At least that was the theory behind doing it. But of course, your other point's really compelling too. Like Pillar 2 is out there, it's happening, and if we're going to go compliance with it, and maybe we'll persuade foreign governments that high tax, low tax does it close enough, but it's not clear that's the answer, and will per country become a necessary piece of shifting to Pillar 2, which at least is a huge thing on the horizon that the U.S. government's going to have to wrestle with for sure.
I think this part of the discussion is the part that's most interrelated with all the other topics at this conference and makes it very hard to kind of make recommendations or evaluate the recommendations, because I do think question number one is, where are we going with Pillar 2? And someone has to decide that. And if we are going to be Pillar 2 compliant, then we have to adopt a per country limitation, unless, as Michael suggested, we can persuade other countries of another approach. So setting that aside, that's like a question that's sort of beyond this panel. Then there's other questions about, I think one of the earlier slides mentioned branch sub parity. That's sort of like out the window with TCJA. We don't have branch sub parity. We don't even want it. As Ron said, we have like benefited income that is in our GILTI system.
That ain't the branch.
Right, exactly. We'll hear about the branch later, and we'll shed a tear for them. But so assuming that's our system, that's also like a bigger question than the foreign tax credit. So assuming we're sticking with the GILTI approach, and maybe we take on some of the refinements that we heard about in the earlier panel, I tend to agree that is sort of a benefited system, and we have, I don't know, I think it doesn't have to be its own basket for the reasons Michael said, but if it is, my interpretation, I don't want to wade into the look-through question that much, but my sort of initial take on it was, this is like an accidentally in the general basket at this point, 904D3 income, and really belongs in the GILTI income. That's the in the GILTI basket, that's the sort of bucket of CFC income we're trying to treat in a certain way. We have, we're aggregating it all, and we have tested income, and we have all these calculations, and then we do a foreign tax credit for that type of income, and I wouldn't have thought of look-through payments as being outside of that, but we don't have to rehash that. But I think that it's sort of like, where do you even make recommendations here depends on a bit of a sort of starting point about what the structure is. If you throw out the branch basket entirely, I don't know what they're going to recommend in the next panel. I haven't read the paper, unfortunately, but that would, then we might be having a different conversation up here.
All right, should we move on to expense allocation?
All right, expense allocation, a part of the foreign tax credit limitation, extremely complex and controversial, partly, I think, because the U.S. really goes it alone here. I think we're the only jurisdiction that has, and certainly with the degree of sophistication that we have, robust expense allocation rules. So why do we have them? Michael touched on this, but just to spell it out, our foreign tax credit limitation is on a net income basis. And so we have three items of income, the three big ones, right? So interest, R&E expense, and stewardship. They are booked in the U.S., but they frequently impact offshore earnings. Just the economists will tell you it's true, and we shouldn't really respect boxes. And so given that, if you don't get expense allocation correct, you are either allowing credits against domestic income, you are violating the principles of 904A, or you are overburdening foreign source income and allowing double taxation. So, again, not what the foreign tax credit's trying to do. So, we have these complex, controversial rules, but they are, one, they're there, which is a virtue. Two, they are performing an identifiable function that is worthwhile. But given all that, what do we want to do with the expense allocation rules? Having said what I just said, we could get rid of it. There is an option for, and especially if we go down the Pillar 2 road, or otherwise we just recognize nobody else does it and they seem to get along fine enough. all the complexity isn't worthwhile. Get rid of expense allocation, adjust rates accordingly, and move on with your life. There's also, with respect to R&E and stewardship, there's also kind of a jobs aspect to it. Like, we like lab coats, we like headquarters jobs. Maybe, and the policy has reflected this over the years, we lean it toward not putting a burden on the foreign tax credit limitation to encourage R&E retention in the U.S., to encourage headquarters jobs in the U.S. If we do keep it, and there are some plain places where it should go. Going worldwide would make sense, probably with respect to both interest expense, so allowing worldwide expense allocation like we had under the 864 F rules. You could also consider in the context of royalty income. And so, how would this operate? You wouldn't have an allocation for U.S. booked expenses against foreign source income to the extent that there is debt incurred offshore, to the extent that there is R&E expense offshore. We don't need an allocation. It's actually happening out there, and you can credit for that. So, seems to make some economic sense, and something that could be pursued in kind of the bite-sized pieces. The other place is with respect to stewardship. The 2022 regs around stewardship are pretty complicated and probably not sound, to be generous. They do it on a company-by-company basis. They respect stock. We probably ought to move that to a worldwide basis and look to assets on a look-through, in how we more normally do our interest expense allocation rules. So, to the extent we've kind of deviated there in stewardship, that's a place where maybe a legislative nudge, notwithstanding our disdain for the legislature, might be worthwhile.
I wouldn't add anything more other than, I think we do have that question Ron said. The rules are there, so do you conform with other countries? They've had a different question. They didn't have rules and they decided not to enact them, presumably in part looking at the US system. Now that we have the rules, do we dial it back? Recognizing that if you do, you might affect things. Although for very compelling reasons, you might choose to dial it back for industrial policy or other non-tax policy reasons. But fixing things seems like something. I'm looking at Barbara in the back of the room, and worldwide fungibility for interest expense was obviously fixed almost 20 years ago. We'll celebrate the anniversary at some point. But had 4 months of life before it was retroactively repealed. Fixing rules like that in R&D, which didn't matter so much, like interest has always been a problem, but global R&E is just reality. I was seeing countries are moving around, so the rules that people were writing 30, 40, 50 years ago have not really been brought up to speed with things, but a real opportunity at a minimum, hopefully, to make the rules work appropriately. So I don't know, turn it over to the commentators.
Was an area where you think Congress should be in?
Certainly the nudge would be good. And again, part of this is just reacting to what are the new norms coming out of TCJA, and again, congressional guidance and a path to follow that's gone through our legislative process is better than a regulatory process which can be variable and variable between administrations.
And limited. I'll say back in the day, although it was a 2004 legislation, the origins of that were in the prior administration, just trying to fix it. And there was concern at Treasury, they talked about different approaches in '86 to at least ameliorate this, but they hadn't done it. And they specifically had gone water's edge. And was it the place of the Treasury to jump in and fix what was an obvious economic problem everyone agreed to, or do you really want Congress to step in? And 864F is another place where they dabbled in and pushed things one way or another because they weren't happy with regs. So,
and just to add one thought, I agree with Ron that sort of a congressional nudge in the right direction might be a directional nudge, might be helpful. And I wonder whether, and I think the paper talks about this, whether if Section 163N was enacted, whether that might kind of come close enough to doing the job of determining how much interest expense to
I think that's a really important point for, those of you in the audience who may say, oh, getting rid of expense allocation is a giveaway to multinationals, we're not measuring net income, and you're going to lose a lot of revenue. When you break it down, stewardship is small, I think is fair to say. And it's not, well, I know there's a disagreement about it, but from a revenue estimate point of view, I think it is small. But if we're wrong about that, then we need to understand it. R&E, Steve and I have a disagreement about whether the regs today are right. The regs today don't allocate R&E expense to CFC stock. They allocate it to royalties and 367D payments. Because those are the reflection of the income from the R&D. You can't, unlike back when the R&D regs were first being discussed in the 70s and the early 80s, back then you could transfer IP to CFCs without tax because we didn't have 367D until 1984. Well, 1984 is a long time ago, right? It's 40 years. There's not much pre-1984 IP that's valuable in CFCs these days. Since then, it's all been paid for through royalties or 367D charges or gain on sale payments. We're not talking about cost shares because there's no R&D allocation for cost shares, right? We're talking about royalty payers. So the royalty is the reflection of the income. The R&D is allocated to that income and not to other CFC income. And to me, that makes sense, which means there's no allocation to CFC stock. With interest, if you enacted 163N, which is the proportionate interest disallowance, then what you're taking into account and allowing interest deductions is the EBITDA or assets of the US group compared to the worldwide EBITDA or assets, which means you're not allowing any interest that is attributable to the assets or EBITDA of your CFCs. So it's being disallowed instead of limited. And that means you don't need an interest allocation with respect to CFC stock. If we could get rid of interest, R&D, and stewardship allocation to CFC stock, and a couple of minor things, maybe state taxes, then separate limitation losses wouldn't be necessary with respect to CFC stock. OFLs wouldn't be necessary with respect to CFC stock. A lot of things would be simplified, and it would be more consistent with foreign jurisdictions. And I think it would raise revenue because 163N applies on inbound as well as outbound, and it's a disallowance provision, not a credit limitation provision like our interest is today. Yes, it is worldwide instead of water's edge. And yes, it's net interest instead of gross. But to my mind, that's actually an improvement in the rule because our financial institutions struggle with this gross allocation all the time. So it seems to me and BBB almost gets there, right? BBB did say we're not going to allocate interest to the GILTI basket, but there's still the Subpart F general basket, limited as it was because they changed Subpart F sales and services. So that they didn't quite get there to get interest out. They did, if I remember right, they got rid of the stewardship allocation in BBB. And so it's not that hard to get rid of, to my mind, indirect expense allocation. It's not a revenue issue. And it would be an enormous simplification if we could just say no indirect expense allocation to CFC stock.
Yeah, well, and I think the last thing I say, simplification is something that's too easy to overlook. But as we move on, our system is already groaning under the weight of what is a very complicated system with Pillar 2 out there. So, and my fingerprints are on the charitable contribution reg. So there's some real merit to at least the other side in the industrial policy, which is, it sounds like we're not doing tax policy, but the entire rest of the Internal Revenue Code spent a lot of time doing that as well. So maybe the international provisions dabbling in it isn't a terrible idea. So with that, we have about 6 minutes. And so I'll try to be relatively quick. And this is, again, one of those places where it all gets interconnected, whether it's with 163N or something else. What do you do with GILTI foreign tax credits? There are a number of specific provisions in the foreign tax credit area that deal with the GILTI rules that one might contend should be up for reconsideration. One is the 20% haircut. All GILTI taxes, we just give away 20% of the taxes. it's interesting. I may be wrong, but I think it is the first instance of sort of systemic double taxation in any country at any time in the history of international tax. It's sort of interesting, right? I mean, we have double tax and we're like, we want to get rid of most of it, not all of it. So, but one of the reasons was giving taxpayers skin in the game. I mean, we had rules that sort of compel taxpayers to at least resist foreign taxes because we don't want them to pay them. There's a sense that if you can pay a foreign tax and get $1 credit in the US, then there's no disincentive for paying the foreign tax, and that's a problem because that is shifting revenues between jurisdictions. The only thing to think about there is, even before the haircut, I think the rules were working pretty well, in part because you never got ahead. I mean, paying $1 to France instead of the United States meant you were in the same place, and the expense allocation rules that Paul talks about are a real impediment in actually getting that full dollar. So I think people hesitated to view those as equals, but clearly today where people are in excess credit position, if you're in excess credit, every dollar of foreign tax is not producing $1 benefit or 80 cents of benefit. It is all dead weight in the system. And so clearly in the current system, it feels like it's a strange moment to have introduced this, I guess, as it turns out, because now everyone's excess credit. Maybe part of the problem is 20% too much, maybe 5% or 10%. There was legislation proposing 5%. I think our general sentiment is it at least needs to be dialed back. Maybe it needs to be done away with. Although, of course, if rates change, then maybe you say when people stop being in excess credit, that natural incentive is now gone in the system. So another one we mentioned is lost taxes in GILTI. GILTI has consolidation. We allowed losses in one CFC to offset income in another CFC. We do that globally across all of your CFCs. But while we allow losses to offset income, we don't consolidate for foreign tax credit purposes. And so losses in one CFC actually reduce taxes in CFCs that have income, and the taxes in a CFC that actually has the losses are also forfeit. And so if we actually consolidated those entities, all of those taxes presumably would have come into the US. Quite frankly, before we had TCJA and global GILTI, all of those foreign taxes would have come into the US at some point. They just sat out there. People would have eventually had earnings. Even if they had deficit companies, they would earn their way out of those deficits. All those foreign taxes would have come back to the US. So in the current world where we're excess credit and people are losing a lot of GILTI taxes, not a lot at stake there for most taxpayers, but you can imagine rates change and things like that. People might start to care, and some might just be, would it make more sense for everyone to be entitled to all of their foreign taxes since they're paying tax on all that foreign income? There definitely is noted, there'd have to be some corresponding changes to PTEP rules and things like that for sure, so it's not simple. The last thing to mention is there's no carry forward for GILTI taxes in the system. It does raise a question of whether we should adopt carryovers like we do in other places. I think going back to the GILTI, there was a sense that we are stuck with an annual accounting period because people have to file their taxes at least every once in a while, but that we've created a lot of rules to smooth that annual accounting period across multiple years because taxpayers have highs and lows, good years, bad years, and GILTI is a place where that does not take place. Again, in a world of excess credits, it doesn't matter a whole lot to taxpayers, but would it make sense to have the system operating correctly so over the long haul this stuff works? The one last thing I'll say about all that, these changes are very affordable today because everyone is at excess credit. So righting the ship, as it were, if you believe that's righting the ship, is easier to do today. If things change, rates change, and all of a sudden everyone's at excess limit, these changes start to have an enormous dollar figure attached to them and stuff. So in some ways, just from the practicalities of the legislative process, now is a sort of opportune moment to right-size some of these more technical things when the cost around them might be quite modest. So that was it on GILTI.
It was a great point in the earlier panel that if that some of these design elements of GILTI seem to be kind of like a rough, have rough justice as their principle, but given how GILTI, the sort of very prominent role that GILTI plays in the international tax system, it doesn't really make sense to have a rough justice mindset. When you have sort of, you get these sort of fact patterns with companies with losses or whatever that are paying high rates of foreign tax and they lose the credits forever, and just very unfortunate tax kind of outcomes that are hard to justify other than sort of like, oh, that's how the cookie crumbles for you.
Yeah, and as we've discussed, I mean, if we move toward a Pillar 2 system, then all this kind of goes away and there's an independent kind of substitution for GILTI. But as is, we're kind of halfway into the existing foreign tax credit rules with the GILTI system, and so all these suggestions are just pushing it fully into the existing foreign tax credit system if we continue down kind of an independent GILTI path.
Yeah. I mean, for me, as I said before, it's like that rough justice. It's easy to lose things in the noise because there's not a lot of dollars in it, but having a system that runs as well as it can for the future, it seems really meaningful. Whereas expense allocation, huge issue, everybody's paying because everyone in the world is an excess limitation. If people had fixed, and in fact did fix in 2004, worldwide fungibility at a time when everyone was excess limit, it turns out that's a lot cheaper thing to do than it would be today because the dollars are huge in that space, even though the policy is so clear. Anyway, back up. No, we're done.
Hi, everyone. We're about to get started with the last panel. Hi, everyone. So this is our last panel of the day. This panel will focus on taxation of foreign branches. Starting with our presenter, we have Amanda Verma, who's a partner at Steptoe. For our commentators, we have Kim Blanchard, who is a retired Big Law partner and is currently at the law office of Kimberly Blanchard PC. Douglas Holmes, who's a principal at KPMG. And last but not least, Dirk Seringa, who is a partner at Covington. Thank you so much. And now I'll hand it over to Amanda.
Great, thank you so much. Good to see everyone. So we are going to be talking today about the U.S. taxation of foreign branches. Our focus today is primarily going to be on foreign branches owned by U.S. corporations and not to the extent they would even be a branch, and Kim may have comments on that, but not foreign business operations carried out by individuals or pass-through entities, although we may delve into a couple of issues going along. So I think a lot of the issues that we're going to raise were previewed on the last several panels, and especially the last panel, with one of the main issues being whether we should have such stark differences in taxation of foreign income depending on the legal form through which the foreign income is earned. And we heard in the last panel about the different categories of rate-benefited income, GILTI, FDII. As we'll talk about today, branch income is not eligible for either of those, and so we'll be talking about why that is and whether we should change the rules. So we're going to have four main topics of discussion today. First, just a brief overview of the current law and history. Second, which I think is going to be the main topic for our discussion, is examining the disparities between taxation of foreign branch income of U.S. corporations and income that is earned through CFCs. We may also, time permitting, delve into some issues with the foreign branch income basket, which you heard discussed on the last panel. And then we may also make a few notes about the interaction of the foreign branch exclusion from FDII, although you'll hear much more about FDII in tomorrow's panel. So we'll start with an overview of current law. And just to kind of set the stage, you may ask, well, why do U.S. corporations operate foreign business operations through branches? It can be for a variety of reasons. One that often happens is because of regulatory reasons. So U.S. entities and financial services may have to, or because of regulatory requirements, may be essentially encouraged to operate their operations abroad through branch form. And there can also be, of course, other reasons for operating through branch form, some non-tax and some tax as well, which many people in this room will likely be familiar with. And when we talk about branches today, we'll be talking about both kind of real branches, so operations that are conducted directly by a U.S. corporation in a foreign country, as well as essentially branches that are, for foreign purposes, legal entities, but have made a U.S. check-the-box election to be treated as a disregarded entity for U.S. purposes. So for U.S. purposes, regarded as carrying out business through a foreign branch. So we'll start with just a brief overview of foreign branch taxation and compare it a little bit to CFC taxation. And then we'll delve into more differences in a minute after that. So as I mentioned, foreign income that is earned by a domestic corporation or in a multinational group is taxed differently depending on whether it's earned through a foreign branch or through a controlled foreign corporation or CFC that's owned by the domestic corporation. So income or loss that's earned by a foreign branch flows directly onto the domestic corporation's US tax return. So it is going to be taxed under current law at a 21% rate, corporate tax rate. Foreign branch losses can offset domestic income in certain cases, subject to various limitations such as the DCL rule and other limitations that may kick in. Generally, for general purposes, transactions between a foreign branch and what you could call the home office, of which the branch is a part of, are disregarded for US tax purposes, with a very important exception to that being under the foreign branch income basket rules that we'll talk about a bit, where otherwise disregarded transactions can be regarded for purposes of determining the income that goes in that foreign branch income basket. Also, a couple of other exceptions to that general rule, such as, for example, the foreign currency rules. So I mentioned the foreign branch income basket. So in TCJA, there were really 3 sets of rules that affected the US taxation of foreign branch income. So the first being that foreign branch income is separately basketed for foreign tax credit limitation purposes, and we'll talk about that. The second major rule that applies to foreign branch income is that foreign branch income is excluded from the FDII benefit. It's not taken into account in computing deduction eligible income. And then finally, there was also a rule that changed the way the branch loss recapture rules work, new section 91. So we'll contrast all of that to how CFC income is taxed, which will be familiar to many people. So as we've heard, especially on the first panel, CFC income is basically subject to 3 regimes. So the first being the historical Subpart F regime, taxed to the US shareholder at 21%. The second being where, and this is where most of CFC income is going to fall, under the GILTI regime. And then the third being basically any CFC income that would be accepted under the deemed tangible return calculation, which, as we heard today, I think there was an estimate that maybe that's 15% of CFC income, so a small amount. And of course, as we heard on the last panel, foreign tax credit may be eligible, or it may be available for CFC income subject to various limitations. And we heard that foreign branch losses can offset domestic income in many cases. CFC losses cannot offset domestic income, and we heard on the first panel today the various rules that can apply to CFC losses. So tested losses of one CFC can offset tested losses of another CFC, but there's no carry forward or carry back. Domestic losses can interact with the GILTI calculation, as was discussed in the first panel, and then Subpart F income, the Subpart F rules have their own set of rules for losses. So I'll pause there, see if I have any general comments before we delve into our first set of issues.
Maybe that the big difference between the taxation of branches and CFC income is the rate that would apply. And query why active income of a CFC and active income of a branch are taxed at different rates. We'll go into some reasons. Maybe the rules ended up where they were, but just from a policy standpoint, income, it's a question why income of the same nature should be taxed differently just because of the form of the entity. On the other hand, branches, the losses of branches, as you said, it gets more favorable treatment. So the advantages and disadvantages of a branch versus a CFC balance out to some degree, but I think at some point we'll come around to the question of whether they should be treated differently and whether branches should be treated as in the same manner as CFCs, at least in part or in whole. And so that will be interesting when we get there.
Yeah, I think it's interesting to think historically how this might have come about. My view of it is colored by the way I think about GILTI, but let me just say, so, prior to the TCJA, it made perfect sense that income from CFCs was not taxed the same way as income from branches. And that is because prior to that time, we only taxed dividends or dividend equivalents. And you can't have a dividend or a dividend equivalent from a branch. So, it would not have occurred to anybody to be even asking this question because, you either operated through a corporation and got deferral, but for Subpart F, or you didn't. But now, now that we have GILTI, which in my view is really just nothing more than the end of deferral for all active foreign income, it doesn't seem to make much sense, right? To have active foreign income over here, active foreign income over here, and GILTI isn't based on dividends or E&P. So I think it was just missed. I think the reason it was missed, though, comes back to something from the first panel. Congress pretty clearly intended GILTI to be a narrow, separate minimum tax. So they weren't thinking about it the way I just said it, which was the end of deferral on all active foreign income. That's not what they thought they were doing. That's in fact what they did do, in my view. And so once you understand that that's what happened, and I'm putting QBAI off to a little hole where it belongs because I don't think it does anything. I mean, once you understand that's what they've done, then I think this question becomes really interesting.
I would say that, in a sense, GILTI is a backstop to having an exemption system, and FDII is a backstop to GILTI, and then the branch basket is a backstop to FDII. So everything is a backstop to everything else. And you sort of, yeah, you kind of back into where we end up with the branch basket, starting with sort of the legacy of deferral and focus on what the CFC is earning and what it's distributing, and kind of leaving branches off to the side, and then you kind of end up, coming around to really treating taxpayers much differently based on how they earn their foreign income, which I think, economists would all agree it should all be the same. It shouldn't be, you earn it through this type of entity and, it's taxed at this rate. If you earn it through that entity, it's taxed at that rate. There is, I guess, a policy background for why we have a branch category, really to prevent cross-crediting for low tax royalty income, but that you never see that in the legislative history. I suppose you have to kind of reconstruct it archaeologically from prior materials. But if you think of it in the way that you said, Kim, I mean, this is really, maybe say it a little differently. If you believe in an exemption system, if you're that side, and if you believe in a full inclusion system, it would seem like how you earn the income really shouldn't matter either way. If you like exemption systems, then branches should be exempt, just like CFC income is exempt. If you want full inclusion, you just fully include everything from the CFC, fully include everything from the branch. And what we have now is really sort of a halfway in between system where you have kind of a full inclusion system at a reduced rate. So maybe you can think of it like a capital gains. Like you're not going to have capital gains taxed at the full rate because you're reflecting a certain element of a consumption tax in the capital gains base. You just sort of tax it at half the rate rather than address the difficult question of whether it should be exempt or fully included.
So I think your comments have all done a good job of setting up the kind of first major issue that we're going to tackle, which is, does it make sense to tax active branch income and active CFC income so differently? And if we conclude that, no, it doesn't make sense, what might a system for parity look like, and what are the technical and policy issues around that? Before we get into that, I just want to cover off another set of considerations when we're thinking about branch versus CFC income. So we talked about the rate disparity issue, obviously. So branch income being taxed at the regular corporate rate, 21%, and active CFC income being eligible for the 250 deduction and potentially subject to tax at the 10.5% rate. We covered the differences in losses between branch income and CFC income. And then just a couple other points as well to consider is one that if you look at how other systems have designed, other countries have designed their tax systems for foreign income, you'll see that many other countries do essentially treat branch income and CFC income similarly. So for example, several countries with exemption systems will have rules where they exempt from tax income that's earned through a foreign subsidiary and also by a domestic corporation through a permanent establishment. So if the US were to adopt this, it would in many ways look more like the rest of the world, although we can query whether that's a good thing in the eyes of Congress or not, maybe not. And on that point, that raises Pillar 2 issues. So under Pillar 2, given Pillar 2 implementation, if the US were to tax branches and CFC income similarly, that would better align the US with the approach on Pillar 2, under which income and taxes of branches in a country are generally included in the country-by-country ETR calculation. So you combine the branch income and the foreign country, local foreign country income when you're calculating your effective tax rate for Pillar 2 purposes. Just the last observation that I would make is this is not at all a new proposal or a new consideration. You can go back far before TCJA and see that many of the earlier proposals considering what would a US exemption system look like, brought up this issue and whether branches and CFC income should be taxed similarly. Just a couple, the paper has some more history on this, but just a couple to highlight. If you go back to the 2005 President Bush Advisory Panel on tax reform, branch CFC parity was in the original 2011 camp discussion draft, and it was also in the 2016 Green Book in the Obama administration. So certainly not a new issue to delve into. So, we'll turn now to, what would the design issues be if we want to think about taxing branch income and CFC income similarly. Obviously, two potential issues here are revenue considerations, although I think Paul said earlier that perhaps this could be a revenue raiser, depending on how one views it in the scoring process. So obviously revenue considerations, we're not going to get into that here. And also potential objections from certain constituencies that may prefer the current regime for various reasons, potentially including tax planning. Also, just to start out with, obviously there's a lot of interactions between what we're going to talk about with respect to how we might tax branch income and all of the other panels that we've heard about today. So if we change how we tax branch income, we want to think about how does that interact with general approach for how we tax CFC income and foreign tax credits, et cetera. But with all of that, so to start with, we'll raise a couple of basic design issues and then I get comments from our panelists. So the four basic issues, and these are teased out in more detail in the paper that were raised are, so if we want to have parity between branches and CFCs, what's the mechanism for doing so? Second issue is, well, how do we define a foreign branch? There's all sorts of inconsistent definitions of branch and foreign branch in the code and regulations. How do we determine how income is allocated to a foreign branch? Also a very important consideration. And then how do we determine the source and character of income that we would consider in our new system allocated to a foreign branch. These are certainly all issues that present a number of complexities. We're certainly not going to be able to solve it on today's panel, but these are some issues that could be considered by Congress, likely many things that would also need to be fleshed out in any regulatory regime. So we'll start first with the question of, so what could a mechanism be for treating branch income like CFC income? And one option, which is, I think, generally the prevailing option in some of the prior legislative proposals, would be to treat branches, foreign branches, as if they are CFCs. So transactions between the foreign branch and the rest of the domestic corporation would be treated as transactions between a separate foreign subsidiary and its domestic parent. And then we would also have all of the other host of considerations about how we apply the rules where a CFC income arises and where there are transactions with the CFC's domestic parent in this case. So as I mentioned, one would be allocating income and losses to branches, the potential application of Section 482, the transfer pricing rules to transactions between the foreign branch and the home office. Also, as I mentioned, sourcing and character issues, and then just the interaction generally of other regimes that apply to CFC income and payments from CFCs. So I'll pause there and see if there's any comments, and then we can turn to allocation of branch income.
You know, we already have 1 foot in and 1 foot out anyways. This is not like we'd be starting from scratch. I mean, you know, the minute that Congress added the new foreign branch basket to the foreign tax credit rules, Treasury and the IRS had to get to work figuring out, how does it work? How do you calculate what goes into that basket, right? And so we've got regulations. They're not perfect. I think you're going to talk about it a little bit more later.
Yeah, if we have time.
You know, but the fact that we've got these regulations, which have been cross-referenced in 987 and other areas like, yeah, they've come up. You're right, and the fact that we have these really kind of is a concession, I think, on the government's part that we're really already there, right? That we have to deal with all this stuff. And, you know, there's a lot of talk about whether we go with treaty, you know, AOA, which I've just now forgotten what it stands for, something. Authorized OECD approach. You know, probably it really doesn't matter that much. You got to do something. And, you know, we may as well do that because that's what other countries are doing. And the last thing I'll say about this, and then I'll be quiet, is that, you know, you sometimes hear people saying, oh, well, you know, this wouldn't be a problem if we didn't let the check the box regs turn everything into a branch. I just think this is utter nonsense. I mean, most countries already treat natural branches as the same as corporations, which is what Amanda was referring to when she talked about, you know, they exempt it. They have the same rules. They see a permanent establishment and they kind of draw a box around it. And for tax purposes, at least. And so I don't really think there's anything there to be very concerned about. I think basically we would just be catching up to what the rest of the world does. I don't know if you agree with that or not.
I think that's a great point. And you raised, Kim, that it's surprising in reading the paper and preparing for this panel how many different definitions of foreign branch there are in the code and regs, and that's a little inefficient and troubling. Why it needed to be that way, that, I mean, in terms of looking at reforms that could be considered, one is maybe trying to bring these definitions together, but even the DCL rules have a different concept of a branch, foreign branch, that is akin to the U.S. branch rules. So that's just another approach you could use. So it's just very interesting how there are different approaches, and the 367 regs in defining foreign branch have a special rule for if you have a permanent establishment in a jurisdiction, that would be, the method to come up with your foreign branch. So that's one response to some of this discussion. The other point I would add to the list of things to consider in shifting to a regime of taxing branches similar to CFCs is the transitional issues. I think that's a big deal in terms of the potential cost to taxpayers if you just if you shifted foreign branches to CFCs, for example, do you treat that similar to the check the box regs as a deemed contribution to the corporation and subject to 367 potentially, and all the potential income that would be generated, especially with respect to IP on that step? And that would be very unappealing to taxpayers in many cases, to have to do that, not unlike the shift to the in TCJA to the GILTI and the 245 Cap A regime required 965 and all the short-term pain that had to be dealt with there. Is there going to be something similar if we move from branches to CFCs, or do we just say magically you were a branch and now you're a CFC, and we're not going to make you have to pay tax on that. We just want to get you on the right track, and if you get a benefit, that's great. If not, SOL. So that's one. These are issues to think about, and there's all the. If there's losses in the foreign branches, you have to think about all you mentioned, Section 91 and the branch recapture rules that would apply in that situation by necessity or force instead of electively.
Yeah, so I think, picking up on some of these themes, I think the key issue really is the contour of the foreign branch. How do you define foreign branch? The concept is, in essence, when are you giving a foreign jurisdiction the right to impose net basis taxation on income based on economic activity occurring within their boundaries? And if you're going to do that, you are either going to follow what the foreign jurisdiction does. Maybe that's a books and records approach. Maybe that's the AOA, which I think is pronounced OW. And and then the question is, to what degree do you override those rules to impose one of the various U.S. regimes on how much do you agree with the way that the foreign jurisdiction is going to do this? Are you going to impose, 1503D, 987, 267 Cap A, 882, 904, and 951 Cap A? Which of those, sort of 31 flavors are you going to impose in order to figure out whether or not the foreign jurisdiction is taxing what the U.S. would consider to be an appropriate amount? So I think narrowing the cases that taxpayers have to confront, which regime to apply for which purpose, having sort of one or maybe two definitions of what a foreign branch is. The 904 regs are pretty good, I think, in terms of a middle ground between the various approaches, but maybe they're not all fit for purpose in every context, but letting a few things go might make life easier. And maybe consider an approach in which, if the jurisdiction in question is a treaty jurisdiction, you just let them tell you what the permanent establishment rules are. Under the treaty, you should have kind of a common understanding. If you have a disagreement with them, you can take them up in competent authority and have a competent authority agreement to address a particular situation. If you don't have a treaty, maybe the best approach or the easiest approach is say, okay, it's going to be books and records with the following deviations.
Or AOA, maybe.
Or maybe AOA. I mean, it is our policy, right? So I guess in terms of conformity, I think disregarded entities are looking more like CFCs by the day. I mean, I sort of struggle to use the word disregarded transaction, disregarded reattribution payment, because these payments are not actually disregarded. So how do you, like, what's the taxonomy of a disregarded payment nowadays? It's sort of like a ghost payment. It's yes, it's here, but no, it's not here. And I think just moving to greater conformity to how CFCs are treated would be sort of a logical. I mean, I'm not anxious to go back to Kintner regs, but maybe moving closer to CFC treatment on the U.S. side might make some of these issues easier to deal with.
So I think we've hit a lot of the major issues. So the importance figuring out what is a foreign branch. So having some definition, which might be if we look to treaties and say that a foreign branch arises where there's a permanent establishment under a tax treaty, or more generally where the foreign business activities give rise to net basis taxation would be one way to do it. And then we also talked about income allocation, so maybe we could use the AOA, or Dirk's new term, the AO. So the authorized OECD approach for the attribution of profits to permanent establishments. So the basic approach under the AOA is that you figure out the profits that the branch would have earned if it was a separate and distinct entity with similar activities and under similar conditions, and acting independently with the enterprise that it's a part of. The AOA is, I believe, the approach that's adopted in the U.S. model treaty. I think if you look at our in-force tax treaties, at least according to an OECD report that I consulted, I think it is in 7 of our in-force tax treaties is the adopted approach. So that would be one way to do it. We could adopt the AOA for treaties where we have that in the treaty, or with foreign countries that have that in our treaty. We could adopt it more generally. We could use some other approach. There are other rules in the U.S. System that we could adopt. The DCL rules have one system, but in my mind, probably not the best fit for this situation because they rely on U.S. ECI concepts. And then another option would be to leverage off of the existing foreign branch income category, which looks at the QBU, or qualified business unit definition. But in my own mind, that's, although we do now have a quite robust regulatory regime around that, may not be the best approach, given that the QBU definition concept was really developed to figure out foreign currency translation issues. And it's not really specifically designed to measure and determine foreign branch income like we would be trying to do for purposes of these rules. Just another consideration, of course, we've talked about country-by-country approaches, certainly, or country-by-country rules, certainly. We would have to consider, if we adopt our branch rules, how that goes into it, and maybe country-by-country means there's more of a reason to have rules that tax CFCs as branches. And then the last point that I just want to pick up on before we talk about the foreign branch income basket, if we have time, is the transition issues, which we talked about in our comments. So major question here is, if we're going to tax foreign branches like CFCs, do we say that there is a deemed incorporation of the branch assets as it springs into life now as a CFC, as was said, like akin to what would happen in the check-the-box elections, the check-the-box election. So I think we covered a couple of the different approaches. One approach would be for Congress to say that 367 doesn't apply at all. An alternative to that would be to say, well, maybe it does apply, but we're going to provide some exceptions, including, for example, an exception that's akin to like the old 367A active trade or business exception. Additional issues, I think, rise in the case of intangibles, where there might be potentially significant future income, and there would be a question of, well, are we concerned about giving an incentive for taxpayers to put intangibles in branches and then down the line be eligible for a reduced rate under GILTI? And the paper talks about a couple of different approaches that might be adopted in that situation. I'll pause there. I think, Kim, did you have a comment on 360/70 issues?
You know, this is really, I don't have a strong feeling about this. This has been a very interesting process because, you know, we're conditioned, those of us who've been practicing a long time are conditioned to think, well, there's this huge difference, right, between a branch and a corporate. We're going to go that way. That means we're incorporating something. So we have branch loss recapture rules and 367 rules and all this stuff that goes with that. But I'm not sure why anymore. I mean, haven't we already paid for all that stuff? I think that this point was made in an earlier panel. I'm not sure that there's all that much really at stake. And you might even just say, well, okay, we're not really going to treat you as incorporating. We're just going to apply rules similar to the CFC rules. Which is basically what they do in other countries. They don't actually treat the entity as incorporated, they just apply similar rules. And I'm not really sure. I don't know if you guys have thought about this. I just keep thinking as we go through this that maybe we're making this too hard.
Yeah, maybe you don't actually have to convert to a CFC, you just tax branches with some of the same attributes as CFCs, the GILTI rate, for example. You could just apply to active income of branches and
you wouldn't allow losses, that's clear. That's the downside.
Yeah, there would have to be a cost.
Maybe it's
to
a
it.
revenue raiser to do this because you wouldn't allow losses to pass through anymore.
But when I was thinking about this, there are a lot of industries, I think, that rely on the fact that they're going to get losses in the early years of their business cycle, and I wonder if there'll be pushback. There would be pushback to not allowing a system that allows you to have foreign branch losses, especially in industries where you have to be in the foreign location and you have early years of lots of expenses and that way. But that's just a side note. But I think there's middle ground here to think about where you don't have to have such a dramatic shift in entity and still bring branches and CFCs, particularly the taxation of active income overseas, to bring parity without having some of these collateral difficult issues to contend with.
I just want to ask, I don't think I need a mic.
Oh, we can hear Mike, we can hear him in the next room.
That's their problem, not mine. The question I had is whether it's worth thinking about this differently, where companies are using branches because they're required to be branches under regulatory authority, which is true of most of the financial institutions, and then where people are using branches because, as Doug just said, they've got early losses and they'd like to use them sooner rather than later. And it seems to me, at least, that for the financial institutions that are required to be branches, it's not clear, other than, quote, some desire for parity, what the problem is.
Oh, is there another comment?
Why don't you go ahead and get into the branch basket stuff for a few minutes, because that's important. We need to talk.
Okay, so we'll leave that question unaddressed and switch to the.
But Paul's really saying
That's
is he wants to talk.
hour. Yeah, Paul wants us to talk about.
You want to make a comment about the
The
branch basket?
miscalculation of branch basket income because of source rules disregarded transaction rules and expense allocation rules was one of the main reasons we started this group, because I couldn't teach it to my students. So please spend a little time on it.
Okay, so we'll shift to the foreign branch income basket. And we've, I think, touched on briefly what are the reasons why we have it. There seems to be a concern about cross-crediting, so companies could use excess foreign taxes and high tax branches to offset U.S. tax on low tax income. Although I did hear earlier today that cross-crediting is a sign that the system is functioning as intended. So just seeing if you're paying attention. So as I mentioned earlier, the starting point for foreign branch income is determined for the new basket and also for the FDII exclusion for foreign branch income. Looks to the QBU rules and the regulations. We start with books and records, and then we make various adjustments to conform to federal income tax principles, including regarding certain disregarded payments. One of the major issues, so I'll get to it, Paul, is that the adjustments that are made under the regulations, the interactions of those and other U.S. tax rules, most importantly, the source rules and the expense allocation rules, can create mismatches between the income that ends up in the foreign branch income basket for U.S. tax purposes and the amount of income that the foreign jurisdiction is taxing. So we can have double taxation in the foreign branch income basket. The paper has some examples of this under the different areas where this raises an issue, so source, expense allocation, disregarded payments. Just a very basic example is the sourcing rules, which we'll hear more about tomorrow. So the very basic example of this, we have a U.S. Taxpayer, a U.S. financial institution, lends money to there has a foreign branch, so U.S. corporation with the foreign branch lends money to a U.S. customer pays interest. That interest is U.S. source because it's paid by a U.S. resident. The interest income in that situation is likely taxed by the foreign jurisdiction in which the branch is, but it's not eligible for the foreign tax credit because the interest is U.S. source income, and obviously we need foreign source income under the foreign tax credit limitation rules. So in some cases where there's a treaty resourcing provisions will help mitigate this effects, but there can still be issues, including especially where we're not dealing with a treaty jurisdiction. So one of the issues that's raised in the paper is, is this an issue we want to deal with? Do we want to deal with some of these mismatch issues? A variety of options to do it. One would be to go to the general parity paradigm where branch income and CFC income is taxed similarly, and we have rules for income allocation and sourcing and character that we think are sensible and would address this. Other reforms might be eliminate the basket, so just don't deal with this particular problem. If we think cross-crediting is a concern, but we don't like the basket, adopt some other approach, including those that were mentioned in the foreign tax credit panel, like maybe a high tax, low tax basket type approach, other rules that might address the problem that I think are going to be addressed in some of the panels tomorrow, like if we made changes to the source rules. But if we do maintain the basket, then how might we modify it to address these mismatch issues with source? One, which touches on the issues that we talked about earlier, would be to change the approach to income allocation. So instead of using the current QBU concept and the complicated regulations where we start with books and records and make adjustments, use some other approach. So for example, the AOA approach would be one way to do it. Or to change the approach to sourcing, which is to have some sort of resourcing provision that interacts with the branch income basket. So the idea being that if we're going to keep the foreign branch income basket, to try to address some of the issues that arise under current law with potential mismatches of U.S. tax and foreign tax.
Yeah, so I would fix the cross-reference. If we're going to keep the branch basket, fix the cross-reference, right? 904 D2H1 Romanet, in a base difference, it puts you into branch, which I think nobody think makes sense. I think for sourcing, I think it's an issue if you think of a branch as basically something that we say there is a net basis right to tax in the foreign jurisdiction. We should make that foreign source. So in the gross income reattribution rules, in the 904 regs, if you're going to reattribute income to the branch, maybe you should change the source as well. And I understand that maybe a statutory change would be necessary to accomplish that, but that's why we're here. The other one I would mention is just FDII So branch and FDII are mutually exclusive, but a branch loss that comes in can have the indirect effect of reducing your FDII entitlement. So you have this thing where, branch income can't give you FDII, but a branch loss can reduce your FDII, and that seems, that, again, if we're going to keep FDII the way it is and the branch basket the way it is, maybe they could fix that and provide a little bit more parity between the two.
Yeah, I think that there's several different ways that the branch income exclusion for FDII, how it interacts with the FDII rules and more generally with the tax rules that raise questions about what was Congress doing in the FDII regime? Are we accomplishing those goals? And are there technical changes we could make or more broader changes that we could make to accomplish those goals? But I think that will be addressed on tomorrow's panel with Pat to talk about the FDII rules.
Do you think if we treat branches like COCs that we need to have a branch basket for the foreign tax credit anymore? I wouldn't think you would need any more.
Yeah, interrelates with the issues discussed on the last panel. Well, what do we do about the GILTI basket? Do we need the GILTI basket? Could we combine just general active to general basket and then have our passive basket? So yeah.
That makes sense, yeah.
I think with that, no comments. I think we have a cocktail hour coming up.